do laundry.
All righty, it is 9 o'clock. You are a glutton for punishment if you are participating in the, is this the 4th annual?
Maybe 5th?
Obamacare
4th, 5th?
webinar. I'm Karen Hasse, this is Bobby Truey. If you look on the screen, you can see that Bobby's name is up here and not mine. I'm just here to explain why. My mom is not in great health and has a medical issue that they think is dental, so you can pray that that's what it is. So I'm taking her to kind of an emergency dental appointment here in about an hour. And so Bobby is the real Obamacare expert anyway, so he's gonna handle this solo. Y'all can tell him what a great job he did to his face, and if you wanna tell him how much you miss me, just do that behind his back. So happy holidays to everybody. I'm gonna dip, have a great time talking Obamacare with Bobby.
Yeah, and also Karen is to blame before she leaves for the Christmas scape up here, the holiday scape.
I made them move the Christmas tree so you can all see it.
And I have to stand now over here to find the middle, so if it looks weird out there, we apologize.
No, we don't.
Okay, so just some of the preliminary stuff. We do have some folks attending here at the KSB office. The rest of you are remotely or paying for the materials to watch later. You have my sympathies, but the concept here today is just like it has been. So if you're brand new and you have never been through one of these reporting workshops before, it's pretty simple. We're gonna try to divide it up, or I'm gonna try to divide it up in 3 basic parts. The first part is going to be, okay, everybody just sit back, not gonna have to take any notes. Where are we right now? Where are we going? What are the timelines? What does it mean to be a full-time employee again? That kind of stuff. We'll kind of refresh and get you what we say, speaking PPACA again. Liking it to a foreign language, I think is exactly right. And throughout, we'll have the opportunity for you to ask questions as well. So after the first part, we'll stop and break for questions. We're gonna get through some of the basics fairly quickly because again, it is our 4th or 5th year at this. And if you're struggling to remember who exactly are my full-time employees, who does this form have to go to, we will cover a lot more of that directly and indirectly as we go through. So if you think, okay, I'm totally lost again right now, don't worry about that. I think by the end of it, hopefully we'll be able to get all that squared away and we've got time for questions. The second part is gonna be going through, well, at the end of the first part will be how they're actually enforcing this stuff now. The second part is where we're actually gonna talk about and go through the 1095C form. That's the one that we spend the most time on. That's the one that goes to all of your full-time employees. That's the ones where lines 14, 15, 16 ask you all the questions and the codes. And so we're gonna go through that in great detail like we always do. Take another break, think of the questions you have, and then we'll finish up by going through the 1094C, which actually has become the most important document in terms of if we have people that have been sent a letter saying you owe an Obamacare penalty, you owe an ESRP it's called. It's been, typically speaking, accidental mistakes on filling out the 1094C, not those 1095Cs. So even if you haven't gotten one of those yet, it could be that you get one and you're like, holy crap, I didn't think we were supposed to get penalized. And for most of the schools that I've worked with, it's been the failure to check one little checks box on the 1094C. So you're probably right. You probably shouldn't be getting that, but it was just one little thing. So we'll go through and explain that. I've helped dozens of schools at this point now with those responses. So even if you know it, you and your board and your administration have worked on setting up a system where we're not going to have any tax penalties because we offer, the insurance that makes sure that it's affordable and all those things, right? You could still get one of these letters. And so I want to talk through that mostly so that you don't call me in tears like some bookkeepers and business managers have, saying, holy crap, it's my fault that we owe $1.3 million. So we'll get to that stuff. So we'll finish up with that. And then at the end, we'll go through kind of the most standard reporting forms, the ones that are probably going to answer 90% of the questions that you get, right? A full-time teacher all year round that takes the insurance, that doesn't take the insurance, a full, other classified staff members, a teacher who's retiring, a new hire, and we'll cover those. And then, if we ask our employees to pay a certain percentage of the single insurance, how do we do that reporting and how do we fill in, the line 16 safe harbors? All this will make more sense, but that's kind of the game plan. So if you have a question, if you've already started looking at some of this stuff, if you can try to fit it into those sections, I think that'll hopefully let us even probably finish a little bit early or have more time for questions. Speaking of which, if you are out there and you're looking at the slides, the second slide has my cell phone number, 605-670-2968. Feel free to write that down if you're not joining live by video. That's 605-670-2968. So you can shoot me a text message and ask questions as we go. If I can stop and get to them, we will do that as much as we can. You can also use the Zoom chat feature, which there's this kind of a screenshot of that on the right. So if you find it at the bottom of your Zoom screen, there's a little kind of oval that says chat. Feel free to send them in that way. Also, if you have any technical difficulties, send them in that way as well. So we'll stop periodically and flash this back up on the screen for you to ask questions, and we will take breaks as we go here so you can refill and download coffee as necessary. Okay. So what has actually been happening in the last year? Since we were here last, kind of wanted to just bring you up to speed on some of the major things. The good news or bad news, I guess, depending on how you think of it, is there really hasn't been anything that's changed. So I'm not going to tell you all that stuff that you learned over the last 3 years. It's totally different and new, because it's not. It's actually the reporting stuff hasn't changed at all. What did happen last year, if you remember last December, we talked about this, is they passed the Tax Cuts and Jobs Act, right? That this was the signature legislation that got rid of the individual mandate. The employer mandate is the one that says you, if you have 50 or more full-time employees on average, have to offer affordable insurance. The individual mandate was the one that said, if you are an individual and you have a spouse or dependents, you can be taxed directly by the government as an individual if you don't get insurance and if you don't get everybody in your family covered. Well, they got rid of that, right? And so I don't know if you've seen this, but nationwide, it went into effect last January 1st. So we're working on a year of this having been in place now. We've gotten calls from schools. We've had discussions with them. Bobby, we have somebody that doesn't want our insurance, but also didn't want to provide us proof that they had insurance elsewhere, right? Like your Blue Cross form asks you to do, or like you do as a routine practice. Well, the reason is a lot more individuals, they estimate 4 million plus that were insured somewhere, just decided because of this law that we don't want to be insured anymore. And so I'm not saying that's a good or a bad thing necessarily, but that's kind of where we are. So there, from the individual side, when your employees go talk to their accountants, they're no longer asking them, do you have insurance? Because if not, we need to prepare for you to get a tax assessment as an individual. So that's no longer in effect. If you go to the IRS's website, plain as day, they have it in there. You can be assessed a tax penalty based on 2016, 2017, 2018, but not tax year 2019. By far the biggest thing that's been happening though, is this employee shared responsibility payment. So step back, think of this when we first started talking about all this stuff. It was the tax penalties, right? Oh, it's not a penalty, it's a tax. Well, this is how the IRS has decided to, what they've decided to call it. It's the employee shared responsibility payment, right? We're going to shorthand that as ESRP as we go through. If you've been the recipient of one of these letters, you'll know exactly what that means. I'll show you what that looks like on a slide here, so that if you get one, you know what you're getting. But the IRS, to their credit, although as we predicted, they're 3 or 4 years behind, is now going through and assessing penalties for those employers that didn't offer insurance to at least 95% of their full-time staff, right? That's the penalty A we'll talk about, the death penalty. And those employers that didn't offer affordable insurance to their full-time staff members if they were a covered full-time employer. So those two penalties, right, are both employee shared responsibility payments. If the IRS looks at your 1094 and 1095C tax filings, they look at the stuff filed by Blue Cross Blue Shield, if you're an EHA school, and they look at the stuff that was provided by the individual, right? Remember we talked about their 5,000 little elves they hired a couple years ago to look at all that stuff together. If somebody, typically in Ogden, Utah, for us here in Nebraska, looks at all that and decides, oh, this employer owes a penalty, they send you a letter that's entitled Employee Shared Responsibility Payment Assessment. So they're doing that now. I'm still working with schools on the 2016 tax year. So that's in some cases asking you to remember back, did Mrs. Smith really resign in March? Or was it February and it just looks like March because that's when the insurance, stopped because it's the next month afterwards. So yeah, it's happening. And typically I think now we're onto the 2017 year, but just so you know, if you get that letter, if you have gotten that letter, I haven't seen any for 2018 yet, but logically that's certainly where we're headed next. Don't ignore them. This is the big thing. And certainly don't freak out. Like I said, in probably 3 out of 4 of the letters that I've gotten from schools, it has a big number in there that they're trying to assess as a penalty because they don't think you offered insurance to 95% of your full-time staff. I have not worked with many schools that decided we're going to take that penalty A. Most schools have offered some insurance, even if it's unaffordable. And it's simply just a matter of how a clerical mistake in checking something on the 1094 form. So don't ignore that letter, but also don't freak out about that letter. Contact your school's lawyer or read through it. I mean, there have been business officials that I've been working with that are really conversant in this stuff. And so said, Bobby, here's what I'm thinking. And I said, yes, that's exactly right. That's how you should respond. And they've been able to get it taken care of. There are some schools. So I want you to now think back about those conversations we were having 2-3 years ago with your boards of education, asking questions like, what insurance are you going to offer? Because if you offer unaffordable insurance, at some point down the line, we may have to pay a penalty for it for those individuals that went to the health insurance exchange. So there are some schools that have gotten this letter and said, yep, we knew those 4 employees went to the exchange. We know we owe the penalty. So they cut a check to the IRS, which is significantly less than if they would have provided the insurance, which was the calculation that your boards were making, right? Back when we were having this discussion. So there are some schools that have gotten that and said, yeah, the IRS actually has it exactly right. These 4 employees, these 3 for all year and this one for 9 months of the year, we know we owe a penalty on them, so we're just going to pay it. And it's actually gone fairly smooth, you know, all things considered, when it comes to the IRS. So in either case, I'm trying not to belabor the point, but just to tell you, pay attention to this letter when it shows up. It's pretty easy to sort through. So this is what it looks like. I've tried to, block out all of the pertinent details. So if you recognize this as your school, I apologize for that, but I think I've got it down to where this is just the stuff that you see. It will have your employer ID number. It will have obviously the name of your school. They've got the name. I don't know what database they're using to pull the names of your schools, but it's been all sorts of crazy ones that I've seen. Sometimes it's just school district number 1. It doesn't have the name at all, like your common name that you think of. So if you get this letter, though, this is what they're talking about. It shows you, if you look at kind of the top right of that letter, the tax year that they're assessing it for, the date that they sent it to you, and then typically they give you 30 days to respond. The IRS is upfront with exactly what they're trying to do here. So this is an example of a school that got a letter that said, holy crap, there's no way that we owe $1.3 or $1.4 million. And the answer was they didn't. So I think that school is on the call here today. I appreciate you letting me use you as an example. I won't name you, but it's one of those deals where, okay, we got this letter. Let's get through. Let's figure out what information they're showing us they have and let's sort it out. Turns out that school owes no money, right? Because we were able to look at both the offers that they made and make corrections to the forms that we needed to, and it wiped out that entire amount. So they go from owing $1.3 million on August 1st to owing nothing, right, when the IRS eventually responds in October. So not all is lost if you get this letter. If it's a surprise to you, let's work through it. I don't know, this might be a little bit difficult for you to see, but basically, when the IRS sends a letter, they do a pretty good job of explaining to you why it is that you might be paying a penalty. So this is going to square exactly with the stuff that we're going to talk about, the 2 possible, right, large employer penalties that we've been talking about for 5-6 years now. The IRS boils it down this way, right? If you have not offered insurance that qualifies, that has the minimum essential coverage, minimum value, all that stuff that we have the luxury of skipping if you're an EHA school, if you didn't offer to 95% of your full-time staff, you owe a penalty, right? And we've known that for years now. The second bullet point, even if you offered to a sufficient number of your full-time staff, at least 95% or all but 5, we'll talk about that again later, you may have offered unaffordable insurance. Or this is the part that I really want you to think about, even if you haven't gotten this letter yet. Imagine the para that you offered full single coverage to goes to healthcare.gov and tries to sign up. And the government asks that para, how much would you have to pay for the insurance offer through your employer? And the para says, gee, like $12,000 to enroll in the full family insurance, right? To the government, that looks an awful lot like you've probably asked that person to pay too much for their insurance, because the para doesn't understand or differentiate the difference between the full single, which is what Obamacare measures everything off of, and the full family. So for a lot of schools, they had totally well-intended employees that decided, we think we can get better insurance and have the government help us out on healthcare.gov by not taking the full single that the school offered and instead saying that the school is requiring us to pay the balance, right, for the full family. Well, if you're starting to kind of hum the bars again of Obamacare, you're remembering that everything is based on the full single. So that para didn't try to lie to you or to the government, but when she says, I owed $12,000 and they compare that to her household income, that's greater than the 9.5%, right, the affordability line. So that's a para who you offered affordable insurance. She did not intend to try to hoodwink the government into giving her an extra tax credit or premium subsidy on healthcare.gov, but it happened that way just because not everybody is fluent in this language. So even that second penalty, if you're saying, Bobby, I know we're never going to get this letter because we offered every full-time employee, including new ones, and we pay at least a full single for everybody. There are things out of your control, like an accidental failure to toggle a checkbox, right? In the Software Unlimited or on the form if you did it by hand. The failure to mark one box means you could get this letter, and any one of your employees accidentally or on purpose, in some cases, saying something different to the government than what was actually true. So it could be that one of these employees has been getting a credit from the government for 3 years now, because we're just now looking at the 2016 tax year or 2017 tax year. It was a mistake back then, even if it was on purpose back then, we're not catching it until now. So you could be getting this letter simply because one of your employees made a mistake or is trying to pull a fast one on the government. So don't freak out if you get it again, but that's the sort of thing that I've seen happen. Let's assume that you get this letter and you totally agree with the payment, right? You pay it. If you look at it and say, yep, we knew we were going to owe this amount of money on these employees, we factored it in from the beginning, we budgeted it the right way, even though we budgeted in a year that's 3 years ago, we knew that we could be paying the penalty. That's great. I'm still happy, or your school lawyer, I'm sure, would still be happy to chat with you about that, to confirm that, to make sure it's right. But if you disagree with that payment, it's actually a pretty easy and pretty clear set of steps that you take. In that letter will be what they call an ESRP response form, and I'll show you a picture of it. There's no heavy lifting done in that form. But to their credit, the IRS says you can submit a written statement, an argument to us about why you don't owe a penalty or why you only owe this amount, but we tried to assess that amount. They will read it. I have talked to the auditors there at the IRS on multiple occasions, and they say, I'm looking at page 2 of your statement here. So this is not something you're just throwing off into the wind, right? They are, to their credit, trying to get this right. They know that we're trying to get this right. So they let you submit a written statement talking about why you disagree with the ESRP they're trying to assess. In your written statement, this is the important thing. Even if you're like, oh my gosh, I have no idea if I made a mistake. I can't remember if I checked that box. Or I know I didn't check that box. What do I do now? They allow you to describe the changes that should be made in both your 1094-C, right, that cover letter, the cover document filing, and any of your individual 1095-C forms. So if you made a mistake on 10 of your paras and how you filled this out 3 years ago because it's super confusing, they let you make that change, and they let you describe to them why it is that you need to make that change, along with actually having you write in what those new codes will be on lines 14, 15, and 16 if you need to. So this is not the sort of gotcha type of game that, to be candid, we are a little bit afraid of. Oops, I accidentally marked down 2A when I should have marked down 2B in line 16. They're letting you go in and fix that stuff and describe why it is that you want to change it. In other words, I think they're recognizing that by and large people were trying to do this the right way, and it was just confusing and unclear in some cases. So then you tell them, this is how I want that person's 1094-C, or how I want our 1094-C or their 1095-C form to read for 2016, which asks you to, dust some cobwebs off the recesses of your memory on occasion. But I think because of how well you all do at tracking this stuff, it's been pretty easy to figure out if there's a mistake. We fix it, the penalty goes away, or we fix it and the penalty is now what we expected it to be. The last thing is you can provide additional documentation. So we've had, in the case where the employee intentionally goes to healthcare.gov and lies to the government about how much you asked them to pay toward the cost of single insurance, you can, for example, include things like the offer document that you made to that person. If you sent all your staff a letter that said, this paras and custodians and kitchen staff, this is the offer we're making to you. And in some cases, if it's a teacher, here's our negotiated agreement, right? This is the offer we made. Clearly, whatever they told you was either an intentional or an accidental misrepresentation of how much they were asked to pay. This was affordable the whole time. So you can even provide, if you have it, written documentation that proves, no, this is what our offer was. And they've been taking that for the most part at face value, right? They're not calling and saying, is that really the document? So again, it's worth your time to dig into one of these if you get it. And I really don't think it'll be as freak out, hopefully for you, as some people have seen it when they first get it. So the most common issues we've seen. So if you're thinking, okay, Bobby, I know I'm never going to get one of these, this is the slide I want you to focus on. Because the biggest issue that I have seen is accidental or transcription errors in the 1095-C form. 2 schools that I worked with, for example, attended this presentation, filled in the 1094-C by hand, and then went on to wherever they were, whatever software company they were using, or to the government's website to actually fill out the 1094C, and just forgot to check one of the boxes. Totally an accident. Their document had it the right way, but they get the letter even though they know we're not supposed to get any tax penalties, Bobby. We gave everybody full single insurance. It was just a mistake, truly. And the IRS, to their credit, has acknowledged that can absolutely happen. So this is an example of what they call their ESRP summary table. Now, if you have gotten one of these letters and you're in a room with other people, don't ruin it. But the big thing here that I look at first, the thing that tells me every time somebody sends me one of these and says, Bobby, holy crap, we owe $200,000. The first thing that I do, I don't read the rest of the letter. I turn to this table and I look at the far left column. The column A that says Form 1094C Part 3, Column A, minimum essential coverage offer indicator offered to at least 95%. Do you see, if you're looking at it, or if you're here at the KSB office, it says no in that column. Most of the time, right, unless you're a school who decided we're not going to offer insurance to paras and custodians and those sort of folks 3 or 4 years ago, that is going to be a yes. The only thing that happened for this school is they accidentally forgot to check that minimum essential coverage box on the 1094C Part 3, which again, if your head is spinning right now, we'll get to all that stuff again. But so the IRS thinks you didn't offer to enough people, even though they clearly did. It was clearly a mistake. So we write back in our response, oh, just change all those to yes. And then it turns out no penalty, right? So it's something that simple that the IRS thinks, oh, you missed the biggest component of Obamacare, when really you didn't. It was a transcription error. Accidental transcription errors on individuals' 1095C forms. So this is an example from a school. If you can see it there, it's also in your handouts, where what they do is they list the employee and then they list the last 4 of their social, which I've blanked out here so that you can't see those employees. And then they go through and they actually say, this is what you put on that employee's 1095C for that year. So in this school's particular case, for all of these employees outside of a couple, they put that 1A offer code, right? Which all of you will be remembering. That's the qualifying offer. That means we offered affordable insurance to that employee and all their spouse and dependents. That's what 75, 80, maybe even 90% of these forms will have on it because of how we offer the insurance. So this, no problem here. This looks okay, right? But I want to show you this one now. This was a school, and it's hard to see, I apologize, that marked 1E in line 14 of the 1095C form. That 1E means we ask them to pay more than, right, that safe harbor amount, which again, we'll talk about all this stuff when we get there. If you put 1E, that means you've asked them to pay some amount, which you then have to put in line 15 of the 1095C form. Some of you two are like, okay, yeah, I'm remembering some of this now, but that's what's missing from this form. So the government gets this and says, okay, you put the 1E code in line 14. That means you ask that person to pay more than, 9 point whatever % of the federal poverty line, so you can't put 1A. But if you put 1E, you have to put in each box of line 15 how much you ask them to pay. Well, this school, by total accident, I think, put 1E when they meant 1A. So the government gets this and says, well, how much did you ask them to pay, right? All they had to do was then go back and supplement and say, nope, here's how much it should have been, or nope, this should have been 1A instead. You literally just tell them, we want that form for that employee 3 years ago to say 1A, and the government says, okay, thanks, no penalty owed. Now, it's not always that perfect, right? But in a lot of these cases, it is something that simple. This is the ESRP response form. This is the one that you have to fill out. It's sort of your cover letter to your response. There's usually a letter either from our law firm or from your school attorney or from you on school letterhead explaining why we don't owe this penalty. But this form has to go back to them. And it has a spot in there for you to say, yep, I totally agree with this payment. Here it is. Or I agree with part of it. Here's a partial payment. And this documentation will explain why we only owe a part of what you're saying we owe at this point. So again, it's not that complicated. Truly, we can get these knocked out fairly quickly if you get one. You can, if this is freaking you out, authorize somebody else, like your school's attorney, for example, to talk to the government if they want to call you. So if you're somebody that doesn't like talking to the IRS on the phone, I don't blame you. But if that happens, you are welcome to designate somebody else. It doesn't have to be you that talks to them and that kind of hashes out, okay, this was in your response, explain that to me a little bit more. So if you're like, okay, I'm comfortable enough to fill out the forms, Bobby, but I'm certainly not going to get into an argument with an auditor at the IRS, I'm your Huckleberry, right? Happy to do it. Okay, So on to the kind of the basics, or just a review of the basics. If you have questions about any of that ESRP stuff, shoot them in, send me a text. But really that was more of just, I want to make sure to reduce the statewide freakout if you get one of those letters, or if you're with somebody that's gotten one and has been able to figure it out. Hopefully they'll tell you, yeah, it's a lot less scary than I thought it was when the superintendent dropped it on my desk and said, what the hell is this? So that's that. All right. So just a quick refresher. And again, I'll just be honest with you. I promise I'm not trying to rush through this, but if you're sitting in this webinar and you're a new bookkeeper, new business manager, and you're like, Bobby, I don't know if we're an applicable large employer, we're probably not going to get to the bottom of that today. So if you send a question that says, are we? My response is going to be, please give me a call afterwards or call your school lawyer. They'll help you figure it out. I just want to kind of give everybody a refresher. So the first thing we're going to talk about is, especially for those schools that are right on the line, how do you know if you're covered by Obamacare or not, right? We're going to hit that in only a couple of minutes. But then this notion of tracking hours and who is full-time becomes important for when we figure out who actually gets that 1095-C form. So if we had somebody who we hired who was full-time in January, worked 160 hours in January, and then quit, do they still get the form, right? And the answer is yes, if they were full-time in even 1 month. So we have to just get refreshed and reacquainted with what it means to be full-time. So I'll put this and leave this up here for just a second, but remember, counting as an applicable large employer, figuring out, are we as an employer covered by Obamacare at all? I just talked to a superintendent yesterday who's thinking about, their board is thinking about changing their cash in lieu in their negotiated agreement. Question one for me, which is not question one for you or the NSCA, is, are you covered by Obamacare, right? Are you an applicable large employer? Because if you are, we got to handle it totally differently. If you're not, less concern. So the question of whether you're even covered by PPACA or Obamacare at all is based on the prior calendar year, counting your full-time and full-time equivalent staff in each month, and then dividing by 12, right? So every month, I explain it this way. If we lined up 12 buckets here on this table, every month, January through December has a bucket. Everybody that we know is full-time, has worked a sufficient number of hours that we know under Obamacare they're full-time, they go into the bucket. So I think your teachers, right, are typically going to go into the bucket at least August through May. The difference between counting to decide if you're an applicable large employer and whether that individual is full-time is you actually treat the summer how the hours they actually work. So for example, your teachers, unless they teach summer school, actually probably aren't in your June or July bucket, even though we all agree that they're full-time, right, for purposes of individuals and getting an offer of affordable insurance from you on an individual basis. So if you only have 10 people that are working full-time in June and July, that's all that's in your June and July bucket. So then once we fill all 12 of those buckets with the right number of full-time plus full-time equivalent hours, so if you have one custodian that works 60 hours in June and another that works 60 hours in June, they're about 0.5 probably FTE, but then together they're probably 1, right? So we put the FTE and full-time hours in each of the 12 buckets. We dump all of those into a big bucket, and then we divide that by 12. What we spit out at the end is called your ALE number, right? Your applicable large employer number. That's what dictates if you're full-time for the current year when you look at the calendar months of the past year. So there could be questions on that. I know that I'm not explaining this perfectly. It takes me a little while to get reacquainted with this stuff too, but just understand, right, that if you're figuring out, are we even going to have to report this year? That is the ALE counting. We're not doing the other, okay, now we know we have to report and we know we're covered which individuals are full-time. So if you have any questions about that, text me, shoot them in on the chat. I'll try to get to them, but I'm gonna kind of leave it at that for now for the ALE counting. So the one that is far more important, and my guess is, for those of you who are, kind of right on the line, you might know a school that knows they're definitely under, right, the 50 number when you're doing your ALE counting. They're probably not here, right? They're off doing something else that you're not able to do because, unfortunately, you are an applicable large employer and they're not. But what everybody on this webinar is going to have to remember is, how do we determine which individual employees are full-time employees? That's going to dictate if they're full-time in at least 1 month of the school year, they get that 1095-C form from you. So this is the definition, hasn't changed whatsoever from the Affordable Care Act regulations. The term full-time employee means, with respect to a calendar month, an employee who is employed at least 30 hours of service per week, or 130 hours of service in any calendar month. The reason we have 30 hours of service per week on talking about it on the average basis is because of that look back counting method that we can do. So if you're brand new and you're trying to get up to speed on the what is a look back counting method versus a monthly counting method, we're going to have to dig into that after this webinar, because I think the purpose of now is just to kind of give everybody that's dealt with this a refresher. But by and large, here's functionally what it means. The 30-hour-a-week average is sort of what everybody talks about, right? If you're going to work 30 hours a week, then you're full-time and you get an offer of insurance under Obamacare. The reason we get to 130 hours in any month is if you take 30 hours a week times all the weeks in the year and divide it by 12 to get it on a monthly versus a weekly basis, right? 30 hours per week, but 130 hours in a month, that doesn't add up. That's 120 and that's 130. This is why. So here's where this is super important, right? So of all the times that you're thinking, okay, I was really focused in on that webinar, make this one of them. If you are looking at your ongoing employees using that look back counting, right? So we're opening up the counting window on August 1st and we're counting all the hours they work through that next July 31st. Then we're doing the math to figure out if they average 30 per week. That's great. You're going to know this person was full-time or wasn't full-time. But here's where the reporting becomes a little bit different, right, than who we're offering insurance to. Because it is entirely possible that you had a retired teacher fill in on a maternity leave. And that teacher only worked, right, that retiree only worked for 3 months or 2.5 months while that person was on a maternity leave. Well, that teacher was full-time in a couple of months, so that retired teacher is going to get a 1095-C form. That's the part of it that's always the most confusing, and it always is the one that's hardest to kind of wrap your mind around again, that no, Bobby, I've got a system now, right? I know who's full-time, and we hire a replacement for that para that quit. I know they're going to work 30 hours a week, so I'm giving them insurance. And I know they're going to get a 1095-C. That's awesome. Most of the people that are going to get this form, you know, sitting here right now who they are. The reason we have to refresh on the full-time employee count is because of those unique situations, like somebody that you hired in December to start in January that quits, or the person that just does a long-term sub or a maternity leave type of situation, or an FMLA coverage type of situation. That person is not going to be full-time when you look at their hours for the year, but they could be in at least 1 month. So that's what, again, just kind of keeping an open mind to what this full-time employee status is. But that's why we talk about you're using the average of 30 hours a week when you're looking at their prior year and figuring out what their averages were for the next year. But for those situations that are dealt with, they only work a couple of months per the year, we're looking at that 130-hour number. This is the other important piece to remember. If you're using the 30 hours per week average, is we exclude the time that those employees have a break of 4 weeks or more. So think of your standard para that works about 35 hours, maybe 37.5, or maybe even 40 hours a week if they're like a special ed para. That para starts, let's say, on or about August 15th and works through on or about May 20th, something like that. In between, you say, well, Bobby, we have a fall break. That's a couple of days. We have a holiday break, which I'm sure you're all going to be delighted to be coming up here shortly after this webinar. That's a couple of weeks in December and early January. And then we have a spring break. That's a week. The short answer is that employee is going to work 0 hours in those weeks for purposes of figuring out if they've averaged 30. But that week still belongs in your denominator, right? Because the only weeks that we exclude from the denominator when you're figuring out somebody's weekly average are when that is a period of 4 weeks or more. So that para from May 20th to August 15th every year doesn't work a single hour, right? They have another job that they work in the summer. That means any week, right? If any week between, any full week between May 20th and August 15th, we exclude that number of weeks from the denominator. So that employee, let's say, works from August 15th to May 15th, they work X number of hours. That's up there in our numerator. What's in our denominator is the number of weeks that they were employed for us, right? So if you have a para that also helps with summer school all summer long, they may have a 52-week denominator. That's entirely possible. Your superintendent, you as the business manager and bookkeeper probably have a 52-week denominator because you don't get 4 weeks off at a time. You might want it, but that's how it works, right? So if you're a 12-month employee, so to speak, your denominator could very well be 52 weeks. But for that para who takes off, let's just call it 10 weeks between that May 20th time and the August 15th time, it is entirely possible then that para's denominator isn't 52, but it's 42. So you are kind of all familiar with how we do that 30 hours of service on average counting. But I wanted to, again, just to kind of refresh you on that. for purposes of knowing when we're talking about 30 hours a week on average versus 130 hours in any month. Typically, most of you are using the weekly average amount when you're talking about ongoing employees. And so that's, again, just kind of a refresher crash course on that. If you are thinking, Bobby, this is super confusing again, I'm still a little bit blurry on that. I promise we'll cover it more as we move forward. But if you have any questions on full-time status, text them to me, send in a chat, and we'll try to address them. Okay. Seeing none. Any here? Clear as mud still? Okay, awesome. Okay, so we talked about so now, you've got kind of at least a little bit of a handle again on what is a full-time employee. Really, the reason I'm belaboring this point is because this is going to dictate who you're giving the form to. Probably at least one time a day, now that all of you are going to be working on these things for either the next couple of weeks or the next couple of months when you have time, I'll get a call and it's, Bobby, I just can't figure out which code to use for this employee. All right, well, explain it to me. Well, they're a teacher, or excuse me, they're a para. They only work 20 hours a week. So we don't have an offer, but they're not full-time. So I'm trying to figure this out. And my answer is they don't get a form, right? Because they don't average 30 hours a week and they didn't work 130 in any month. So that's why this is important, because eventually you're going to get to what I call the crumbly bacon, right? Those employees who didn't fit neatly into one of the other categories for the 1095Cs. And you got to, in a lot of these cases, the answer is they don't get a form. If you're like, none of these codes apply, it doesn't make sense to me, you're probably understanding it exactly right? They just might not get a form. What are the taxes? So remember, the IRS calls these the ESRPs, and we've always called them the shared responsibility taxes because they're not a penalty. Otherwise, this law would be unconstitutional. But they're a tax. And so when the IRS sends you an ESRP, it's on one of these two things. And we kind of talked about it, right? Penalty A, or the 4980HA penalty, it's called. We've noted as the death penalty. It's a bit pejorative, but the concept is we failed to offer insurance to 95% or all but 5 if we have fewer than 100 full-time employees. We didn't offer to enough people. This is the one where those folks got in trouble because they forgot to check the box that we offered to 95%. So when the IRS sends a death penalty letter, it's usually just, oops, check that box again, and the whole thing could go away. But that's the first one. If you're not sure that you met this, become sure before you finish your reporting, right? This is the one where I think everybody now is probably on a pretty good system. Even if you're newer to your role, hopefully there were some notes, or you've got an administrator with some institutional knowledge of this stuff that explain to you how we decide that new pair that we're hiring, do they get insurance, right? Or how are we tracking the hours to figure out if this individual or that individual is full-time for purposes of us having to consider them full-time and offer them insurance. But that's again, the death penalty. That's the one that says we just straight up, we may have offered good insurance, but we didn't offer it to enough people. Penalty 2, this is the one that we're, or penalty B, this is what we've always called the affordability penalty, right? This is the individual employee penalty. This is when, yeah, we offered to enough people, but we told our paras that we're only going to pay 50% of the single premium, or we're going to pay none of the single premium and you can cover roll if you want to. That counts as an offer, right, for penalty A purposes, but it could be unaffordable to that individual that you offered it to if it's a single para that makes $12,000, $13,000 a year and you're telling them you got to pony up $6,000 or $7,000 for single insurance. That's obviously, as we'll talk about, going to be unaffordable for them. So a lot of schools that have gotten that ESRP letter from the government have gotten a penalty A because they forgot to check the box, but they also get a penalty B because some of their employees, like we talked about the para that either intentionally or accidentally told the IRS how much you made them pay for this cost of the insurance, that employee has triggered the government system to say, oop, they got unaffordable insurance from the employer. So if you go back and look at that ESRP summary table thing that I sent you, it's a couple slides back. I'm not going to click all the way back there. But in one of those columns further to the right, it shows the number of employees that went to healthcare.gov and got the premium tax credit from the government. So if what you're thinking is ours should be none, we shouldn't have any employee on there because we offered everybody a full single insurance, again, that doesn't change what they may have said to the government. So the government might think that that person qualified for a premium tax credit on the exchange, right? Even though they didn't. So this is why, again, it's important to just kind of remind yourself and refresh yourself. What has to happen before the government thinks we might owe penalty B, an unaffordable penalty? And the answer is, number one, that employee has to be full-time. So a number of the calls that I've gotten have been about an employee that didn't get a 1095C form because they weren't full-time. A 20-hour-a-week para went to the government and answered, yes, I'm full-time at XYZ public schools, and yes, they didn't offer me insurance. So from the government's perspective, that person is a full-time employee who didn't get offered insurance. They may have been lying to the government. They may have made a mistake. They may have talked to their friend who said, if you don't check that box, they won't give you any premium tax credits, right? But the whole concept of whether you as the employer are going to be assessed a penalty is that employee has to be full-time. Your insurance offer to them has to be unaffordable, which we'll talk about here again in a second. They have to go to healthcare.gov, right? They have to enroll in healthcare.gov, and they have to get the government to agree that based on what the employee represented when they filled out the application, they're entitled to this premium tax credit or the premium subsidy on the health insurance exchange. If all of that, if one of those things is missing, right, or if any step in there is missing, that employee should not be entitled to a premium tax credit, and you should not have to pay a penalty. But you're not going to be able to sort through why Jane Doe showed up on one of those ESRP letters unless and until you know all of those facts about Jane Doe. Was Jane Doe actually full-time? What insurance offer did we make Jane Doe? Did we make sure that she could enroll her spouse and dependents? And did she actually go to healthcare.gov and get a premium credit, right? Well, if you're getting that ESRP letter from the government, then Jane Doe did the second two things. The question is whether Jane Doe told the government the right information about the first two. Was I full-time? Was my offer affordable? That's where you could be getting one of these letters, even though you know that you're off, that you shouldn't be, right? Because your offers were acceptable. Okay, so how do we know if insurance is affordable versus unaffordable? This again is the part that we're going to have to sort through, not necessarily for reporting purposes. It is to some extent, but not exactly. But when you get that ESRP letter, if you get that ESRP letter, you're going to have to be able to say to the government, no, Jane Doe's offer was affordable, and here's why. So for 2019, right, remember these numbers are adjusted every year. You could be offering unaffordable insurance to any employee if you ask that employee to pay more than 9.86% of their household modified adjusted gross income. So that's their and their spouse's income together, right? But it's 9.86% of their household modified adjusted gross income toward the cheapest single plan that you offer. So 9.86, remember way back when that was 9.5. That's where we got the 9.5% of their household income stuff. That number is now ratcheted up for 2019 to 9.86, and it's going down for 2020 to 9.78. So that number is going to continue, I think, to fluctuate there. So if one of your purposes of today is to say, when we get to the new insurance year next year, Bobby, how much can we ask people to pay so that we can still code with 1A, or so that we can know that it is still affordable? You're going to be working with a different number than we're working with now for reporting purposes, which is looking backwards. Right? We know the number for 2019 is 9.86, but we also know the number for 2020 is 9.78. So when we show up next year, if you want to be able to prove that we didn't ask them to pay so much that we couldn't use the 1A offer code, which again, we'll get to all this, but you're using a different number for that. So I just want to put a footnote out there that what we're talking about today, this 9.86 number, covers the 2019 calendar year. What we're going to be talking about, if this is still the law next year at this reporting webinar, is 9.78. So just understand for our purposes, for your filling out the form purposes, it's 9.86. If we asked Jane Doe Parrott to pay more than 9.86% of her household modified adjusted gross income toward the cheapest single plan, then Jane Doe Parrott's offer was unaffordable, right? So go back to the example of where we asked Jane Doe Parrott to pay 50% of the single. If you got a $7,000 single and Jane Doe has to pay $3,500 of that, take $3,500 as a fraction of her, as a portion of her $13,000 take-home pay, right? You're talking closer to 30-40%. So Jane Doe's offer is unaffordable. Now, your board may have said 3 years ago, we know that Jane Doe's offer is unaffordable. It's cheaper to pay the penalty than it is to pay for $7,000 of insurance. That was a total employee benefit board local level decision. But you are now, if you're reporting, saddled with understanding, or if you get that ESRP letter, was that part of a decision that we made? Do we know that? Or was there some mistake in there? And this is one of the main ways that you're going to catch that. So keep in mind then, we don't know what their house, well, first thing, the single only insurance plan. This is another one of those times where, all right, Bobby, it's warm in our room. My eyes are glossing over. I need more coffee and I have to pee. Bear with me for just a second. The government doesn't care, for the most part, for reporting purposes, what actually happened. The government cares about what the employee would have had to pay toward the cheapest single plan that you offer. Example, we offer what's going to be the new, $1,050 deductible PPO plan, straight up old school PPO insurance, no HSA, none of that stuff. It's just, that's my deductible level, right? We also have a dual choice where that employee can enroll in the $4,000 high deductible HSA eligible plan. Even if that employee elects to take that more costly, $1,050 deductible PPO plan, reporting wise and for penalty purposes, we look at what it would have cost if they took the cheaper high deductible plan. So again, now's the part of the presentation where I tell you only the government will ask you to suspend reality when you're telling them what actually happened, right? The government doesn't care what actually happened, short of did they enroll or not, right? What the government cares about is what would they have to have paid toward the cheapest single plan that you did offer them. So that's why if you offer straight up only one plan to all of your staff, right? For teachers, administrators, 12-month staff, 9-month staff, we're all on the $1,050 deductible. We offer everybody the full single insurance. That's great. That's easy breezy. But if you have that dual choice plan and most of your staff, right, are taking the more expensive insurance because it's better, you still are going to have to code them based on the cheapest offer you made. And that's true from your paras all the way up to your teachers or your superintendent. If the superintendent had the option to enroll in the high deductible plan because we gave that superintendent or the other administrators a dual choice, we have to report for them, right, on the cheapest single plan, not the plan that they actually took. Send questions, text questions, but that's one that we'll return to. Now, keeping in mind here for both penalty and reporting purposes, right, we have those three safe harbors. We don't know what the person's household modified adjusted gross income is. So what the government has said is, we've got a way that you can explain to us that we only ask that employee to pay a certain amount such that we could compare it to one of three things. Number one, what is in box 1 of their W-2? If we only ask them to pay 9.86% of what's in box 1 of their W-2, then we have what's called a safe harbor. The government will assume that they don't have to send an elf through to check our paperwork to decide if we owe a penalty, because we are representing that we didn't ask the person to pay more than what's on their W-2, which the government says we're going to consider that good enough to assume that that's not asking them to pay more than 9.86% of their household income. The second one is the single federal poverty level. We'll talk about more, I'm going to skip that one for now. We'll talk about that when we get to the reporting stuff and the coding of those forms. But if you ask an employee to pay no more than 9.86% of that year's single federal poverty line, which is I think $12,490 or $940 for this year, I got it in there later. But if we ask an employee to pay no more than 9.86% of that number, we know that we get to code it with a safe harbor. The last one, and this is the one that most employers are using that I work with, that are still asking employees to pay any portion of their insurance, is what's called the rate of pay safe harbor. That is, Jane Doe Para or John Doe Para makes $10 an hour. We know that that's all they make. They don't do any sponsoring. They don't do any bus driving. They don't do any, fill-in part-time work for any other part for the school. They just straight up make $10 an hour. It's the only wage they have. You can fill in that we aren't owed a penalty, right? That we have a safe harbor. If you don't ask them to pay any more than their daily or their hourly rate, $10 an hour, times 130 hours a month, 9.86% of that. If we take Jane Doe's $10 an hour times 130 hours, right? We know that we have $1,300 there. If we ask Jane Doe to pay no more than 9.86% of $1,300, we can check the rate of pay safe harbor. There are some schools that have told employees that we're going to make you pay 10% of the insurance premium, or we're going to make you pay 25% of the single insurance. They're not intending to, but it is possible that one of these safe harbors could still apply. So if you ask employees to pay a certain amount for their insurance, it is still worth your effort, in my opinion, to see if one of these safe harbors applies. So that rate of pay safe harbor is the one that typically is the most, right? That's the one that maximizes the amount that you could ask them to pay for your safe harbors. And again, that's their hourly rate times 130 hours in the month, regardless of how many they actually work, right? Here's your government suspending reality again. Take 10 times 130, take 0.0986, and that's how much you can ask them to pay while still using the safe harbor code. If it's a penny over that, we can't use the code. Doesn't mean you're going to owe a penalty, because the little elf has to figure out based on the household income, not on the information just that you know, but that's how the safe harbors function. And we're going to get to those. There are still plenty of schools that code their 1095Cs with those safe harbors. What is the penalty for 2019? If you go through the reporting and realize we may owe a penalty, or if your board said years ago, we're fine with assuming some of these penalties, that amount for 2019 is, I think it's still a proposed amount, although that typically means it's going to become final. But remember, this was the one that was $3,000 a year when we started so many years ago. That's now up to $3,750 a year, or assessed monthly, which is how they do it, $312.50 for each month in which that employee, right, goes to healthcare.gov and gets the premium insurance or tax credit. Any questions about that, text them my way. I'll put my number up here again, shoot them through the chat. But that, again, that's just the unaffordable, affordable difference there, and we'll cover more of that when we get to the forms. Any questions? All right, we are going to take a break, I think, right now, because, well, here. Yeah, we're going to take a break right now. This is a good spot for it. That's plenty of information overload. Let's say 10-minute break, and we'll come back right at 10 o'clock. Send questions in, by the way. Here, I'll get to... Here we go. Send questions in if you have them. Okay, we are back on. No questions came in, so that means you're gonna have to tell Karen that I was just excellent, that it was perfectly clear to all of you. No, in all seriousness, I know that we kind of breezed through a lot of, I mean, that's dozens and hundreds of pages of regulations that we went through really, really quickly. So if you have a question, let us know. Okay, perfect. Thanks, Roxanne. Yeah, that's, somebody said that that she had lost audio. Yeah, I'm gonna mute us on our side. So when Karen or Steve comes in here and starts cursing fervently, you don't hear that when we're during the break. So hopefully everybody's back now. If you have any audio issue, let us know. I'm gonna bop back just a couple of slides here. I felt like it was a good time to take a break because I was getting tired of talking about Obamacare rules. But here's where we left off, right? What are your reporting requirements? So the stuff that we just talked about in the first hour, put that in a nice, neat little box, set it over here, leave the box open because we're gonna have to grab out some of those tools still. But we're gonna move now for the next 2 hours and focus exclusively on the reporting that you're gonna have to do. Like I said, we're gonna apply some of those rules. We're gonna talk about them and refresh on them. But now we're gonna get into the guts of the reporting obligation you have. So the purpose of these slides, as it has been every year, and the purpose of recording the webinar, or allowing you to come in and get it later if you want to, is so that you can come back in and say, okay, I just want to hear it again to start speaking the language. One of the good things that I'm going to tell you is these forms, the 1095-C forms, aren't due January 31st. They've kicked that deadline out. So we'll get to to March 2nd, but we'll get to that in a little bit. So you have more time than you normally do. But I know that many of you are sort of type A, or at a minimum, I just want this crap off my desk. And so might be working on this when staff are bothering you less during the holiday weeks and then, shortly after that. So we're gonna go through it right now in full detail, but you can always come back and access it later. And what we'll do with the recording is we'll actually chunk it up. So that we're gonna have links. I think we've done maybe 10 different segments before. I don't know how many we're gonna do this time. Karen and I will figure that out. But if you're like, hey, I just wanted to go back and refresh myself on what do I put in line 14 to the 1095-C form, we're gonna try to have that chunked out so that you don't have to scroll through the whole webinar. So if you find yourself scribbling notes or thinking, hey, I wanna hear that again, it will be available to you. Because I know this stuff can be like an avalanche, right? Given what we've already talked about. Now we're gonna go through all the weird coding rules and all that. So we'll go through it as slowly and as methodically as we can and try to get to any questions you have. Okay, so who must file the 1094 and 1095-C forms? This, again, is the reason that we have to look at whether you're an applicable large employer. Now, to repeat myself one more time, probably everybody in here has either decided that they're either really close or that they are an applicable large employer. Those smaller school friends of ours that know that they're not aren't even on this webinar. But again, this is just a refresher. But the reason I put that up here is not to highlight that point. It's to highlight this point. If you go about halfway through that paragraph, after the parenthetical that says not filing multiple forms 1094-C, you must file a form 1095-C for each employee who was a full-time employee of the school or ESU for any month of the calendar year. That's why we have to go through and figure out, did that long-term sub who was on a maternity leave work 130 hours in that month? Because there's two ways to be full-time, right? We average 30 in a week, or we work 130 in any month. So the rules themselves, I wish were a little bit cleaner, but I think that's actually pretty clear, right? If they meet either of those two things in any one month, arguably, we should be reporting for them. So if you have a para that works all year 20 hours a week, and we know that para wouldn't be full-time on the average, right? But that para, because we have another para on maternity leave, takes a full-time position to make up for some of that work and works 140 hours or 130 hours in a couple months of the year, we have to then figure out, did that increase their average, right? But even if that didn't increase their average, we may still have to report and consider them full-time for those 2 months, even if we didn't offer them insurance. So that's where this gets confusing, is when you have somebody who works for you regularly, that on the look back method, right, or the counting the last prior year and averaging whether they hit 30 a week, they may not get insurance from you and they may not meet that average, but in a month they may have, right? If they filled in and did substitute activity driving, The number of things that you have people do, because we don't have awesome pears growing on trees, right? You have folks fill a lot of different roles as you need them. You probably fill some of those roles. But so that's why you have to be conversant with the fact that if you have an employee who's full-time in any month, that employee is entitled to get the 1095-C form. So that's why I put this part up here, because that's straight from the instructions. So the two documents, the two forms that we're primarily working with, if you're new, or if this is a repeat for you, just kind of remember again, the 1094-C, that's the transmittal letter, right? That's like the thing, it's a version, it's different, but it's similar in concept to the sort of the transmittal form that you have for all of your W-2s or your 1091s. That form, right, is the one that explains to the government, here's the school, here's who we are, here's how many of these 1095-C forms we have because of our full-time employees, and it gives them other information. That's the 1094-C. Even though it's numerically before 1095-C, we're gonna actually talk about that last, because some of the 1095-C stuff, which is the individual employee form, is gonna impact that, how we fill that out. This form is due to the IRS if you're filing it on paper, which I don't think many folks are anymore, whether you're an APTA-Fund or a Software Unlimited, I think for the most part, they've got an electronic filing that you can work with. So if you're filing that form on paper, it's due February 28th. We're in a leap year, so it's actually not the last day of February. If you're filing it electronically, it's gonna be due March 31st, 2020. So that's your deadline to send all this stuff to the IRS. The 1095-C form, the form that goes to the individual employee, right? That is submitted, the stack of those is submitted with the 1094-C. So you're not actually giving the 1095-C to the government until you also give them the 1094-C form. That is due, the 1095-C must be given if the employee is full-time in any month. That's not due January 31st. That's due March 2nd, 2020. So your employees are going to try to get their taxes done. Their tax person is going to say, where's your 1095-C? You're going to tell them, well, maybe you'll have told them, we're not giving these out until March 2nd because that's not when they're due, but they're going to say, well, I can't file my taxes. And you're going to say, I'm really sorry. But so we're going to have to dance that dance like we do every year, but they have extended that. So if you have employees who disbelieve you, if you want to just look at it for yourself, one of the documents in the link that Sherry sent all of you is the IRS notice. I think it's notice 19-84, I can't remember. It's the only one of its kind in there. But if you pull that up, it says, plain as day, the obligations under 6066, or which is basically the regulation code section for these 1095-Cs, extend the deadline from January 31st to the 20th of March. We have a question, I think. Oh, there you go. Yeah, this is a good idea. Please provide a chart for any acronyms used. I will do that. I tried to put them in the slide titles, but I will do that. That's fair. That's a lot of acronyms. But I will send that. I'll add that to the list of materials here when we put them out. Okay. So there is a 1095 and 1094-C form, but there's also a set of 1094 and 1095-B forms. Make sure if your software offers both, you, as the school that offers a fully insured plan, in other words, if you don't self-insure as the school, the handful of schools in the state that do, you're a little different. If you have questions about that, call your school lawyer. But if you use EHA, you have what's called a fully insured plan, so you're not going to be filling out the 1094 and 1095-B forms. Those are filled out by, generally speaking, by Blue Cross Blue Shield. That's the stuff where the blues indicate to the IRS, yes, these plans meet the minimum coverage requirements of Obamacare. They provide the minimum value that Obamacare requires. You, as the school, unless you're self-insuring, aren't required to fill those out. They are similar enough that you might not be able to tell on the face of them. So make sure that when you're going and inputting your data, especially if you're doing this for the first time, you're not popping open the B forms to populate. You're looking at the 1094 and 1095-C forms. Okay, so on to the 1095. This is the one where you're going to spend a majority of your time as you get ready to code this stuff. It's similar to your W-2 reporting like we talked about. This is essentially where we tell the government, here's the employee, here's the school, here's the offer of insurance we made to them, here's how much we asked them to pay, if anything, and did they enroll, did they not enroll? If they didn't enroll, do we have a safe harbor code? The lines 14, 15, 16 of this form, that's the gut. That's where you're going to spend 90% of your time on all this reporting. Each employee receives a copy if they're full-time in any month of 2019, and especially if they're full-time in the preceding look-back period. We'll talk about that little nuance here in a second. But the concept is, if you send in a 1095-C to the government, they are going to presume that that employee met the definition of full-time in at least 1 month. You see why that's significant? Because if you had that employee that went in and told the government, I'm full-time in every month, but they were really only full-time in 1 month, that could be where you're going to have to use that ESRP response we talked about for the tax penalty letter and say, hold on a second. He or she wouldn't have even gotten this form but for that 1 month where they did that long-term subbing, right? So keeping in mind, when you send this to the government, this tells them, this is where we're making our assertion of whether that employee is full-time or not. That's teachers, that's superintendent, all the way on down to a part-time para, right? Anybody we're sending a 1095-C, we're saying to the government in at least 1 month of 2019 they were full-time. That's why it's so important to make sure that if you don't have an employee who is full-time in at least 1 month, we're not sending the 1095-C, because we could accidentally be corroborating a mistake that they made when they reported to the government. So knowing who gets one is really step zero, if you will. If you file this with a 1094-C electronically, that 1094-C is due February 28th. But if you're filing your 1095-Cs and all that with your 1094-C on paper, those are due to the government not until March 31st. Difference here though, right? They're due to the employee by March 2nd, but they're not due till the government until March 31st. So you have to, if you're an applicable large employer in ALE, that's one of our acronyms, you have to give this to those full-time employees. You must file them regardless of potential tax penalties. I had a call last year, I get one every year. Bobby, if we send this in, they're going to tax us. Yeah, that's kind of part of the deal that we struck, right? That when your board was deciding, are we going to offer affordable insurance or not, or at least what we think is affordable, that was one of the things that they were agreeing to, is that we may get a tax penalty. So there is no, if we file, holy crap, if we file this, they're going to penalize us. You got to file with fidelity. It's under penalty of perjury, right? But they still have that. But if you're giving it your, best effort, if you're doing it in good faith, they're not going to come and, give you a criminal penalty for perjury. They will if you intentionally don't file one because you're going to get a penalty, right? That is perjury because you're lying to them. This again assumes that you've calculated full-time status for each of your employees. Easy breezy for all your full-time teachers, administrators, 12-month people. We know in at least 1 month they're probably full-time, right? That's not what we're worried about. But the government says it's also perjury if you failed to send us a form when you should have, right? So we need to, again, just make sure to assess whether the employee is rightfully getting that form in the first place. Your deadline to get it to the employees, March 2nd. Again, notice that's different than the deadline of when you have to submit the 1095s and the 1094 to the government. That's March 31st if it's electronically. And employees will begin asking for it annoyingly on January 2nd, or as soon as your W-2s go out and they don't have the 1095 with it because they just forward all that stuff to the accountant and they're going to say, well, we need your 1095. Sorry about that. That's just part of what they do when they extend our debt. So listen, the fact of the matter is they're due March 2nd, but there's nothing that stops you from getting them done earlier. But I want you to know, right, that you've got that extra time if you want it. Okay, so part one of the 1095-C form. Not a lot of fanfare here, not a lot to point out. And so for those of you that are new to this, or if you're just kind of getting back into the flow of how we do this, we break this down, right, into each section of the two different forms and then into the subsections or the individual lines when we have to. So we're going to start at the top of 1095-C, work all the way through it, go to the 1094-C, start at the top, work all the way through it, and hit the finer points as we go. So the only thing, again, that I'll repeat here is that you've got to give this form to any employee who's full-time in any month. So if you've got Peter Para, who's full-time in 9 months but has the summer off, and you have Connie Cook, who's full-time in January, but she quits February 2nd, both Peter Para and Connie Cook get the form. Same with Danny Driver. He was a custodian last year, but this year he only drives bus. The question is not what is their full-time status the day you hand them the form. The question is, were they full-time in any month of 2019? So when we have that teacher who retires, does their 6-month sit out and then start subbing for us, right? At the time they are subbing now, they're probably not a full-time employee, but we're reporting on the tax year 2019 and we're looking at the months in 2019, not where they are right now. So Peter Para, Connie Cook, and Danny Driver are all going to get a 1095-C. because Peter Para, Connie Cook, and Danny Driver were full-time in at least 1 month of 2019. And again, the information that you fill out in the employer part, right, the left side of this box and the right side of this box for the part 1, that employer information must match up with the 1094C stuff. And I've had some schools where the government sent it all back to them and said, we don't think you're the same person. It was just a, transpose school district numbers 0010 to 0001 or something like that. So they're supposed to, the government says, match up. Make sure that they do before you hit send. I think the software companies probably take care of that, but that's one of the things they really emphasize in the instructions. The new hire rules are a little bit weird. I'm not going to cover those in detail, but what I am going to say is, generally speaking, here's how they work. You hire somebody who is going to be full-time and you know it. You hire somebody who's replacing somebody who is full-time. They're supposed to get this form, even if the first month that they work for you is December of 2019. Right? Because if you know they're going to be full-time, you're supposed to offer them insurance like you do for other full-time employees. Similarly, if you know they are not going to be full-time, let's say this December you had a part-time para that resigned at the end of November. You hire a part-time para to start December of 2019 this month. You know they're only going to be about 20 hours this month. You know they're only going to be about 20 hours every month moving forward. You don't give them a form, right? Because you know they're not going to be full-time. Then there's the weird people in the middle where you're like, I'm not sure. So for lack of a better way of explaining it, the safest route is to offer them insurance if you think they might be full-time, but that's, tough to take that back if it turns out they weren't. But you do have the ability to track somebody's status for the next year, measured from their start date, to decide if they are full-time before you offer them insurance. So most of the time, I think schools probably know, yeah, we're hiring this person, they're going to be full-time. No, they're not. If you're really not sure and you're deciding whether or not to offer them insurance or whether or not to give them a 1095C, call your school attorney, because these are going to be harder to report. But I just want to throw out there that for those mid-year hires, what the IRS asks you to do is decide, do we know for sure, or do we know that they're definitely not going to be full-time at the day we hire them? That dictates how you're supposed to handle it from both the 1095 reporting side and the offering insurance side. Okay, so that's part 1, fairly straightforward stuff. That's just kind of the demographic information, the employee information. Part 2, lines 14, 15, 16 is where we're going to spend a majority of our time, the rest of this webinar, and where you're going to spend a majority of your time sorting through the codes. So for those that don't remember, you've got the 3 lines, 14, 15, 16. This must be filed for all 1095C recipients, even if you don't offer them insurance. The question is not, did we offer them insurance? The question is, are they full-time in at least 1 month? It is not, oh crap, we're going to owe a penalty, right? It's, were they full-time in at least 1 month? And if so, we've got to give them this form, even though we're telling the government we didn't offer them insurance. There is, on the far left-hand column, the furthest blank column after the descriptions of the lines, is the all 12-month box. If every month is the same for the calendar year, you mark it in all 12 months. And that could be true of any of the lines, right? We'll talk about, because EHA is not a calendar year plan, we'll talk about how that's not likely, especially if you have to use line 15. And you could have somebody who wasn't on insurance last year, but then for the 19-20 year decided to jump on, right? Because we had open enrollment. In that case, when we're coding 2C in line 16 to say, yes, government, they enrolled starting in September, right? So we're not going to be able to use all 12 months for line 16 because they just decided to enroll this year, even though they didn't last year. So it has to be static across the boxes before you can use the all 12-month coding. If any of offer, cost, enrollment, non-enrollment, safe harbor codes, if that's different so much as in 1 month, you can't use the all 12-month box. I think that's pretty self-explanatory, but I get questions every year on that. And again, this follows the calendar year, so we're covering 2 EHA plan years. This is why I say, if you have employees paying a certain amount tethered to a percentage of the single, that's by definition with premium increases going to change from August to September of every year. So you're probably not going to be using the all 12-month box in line 15 if you have to code that, because the amount that you ask them to pay. So just kind of keep that in mind. Here's the big one, and I'm going to pause on it. If you're like, Bobby, I get it, I'm sorry, but I just want to drive this home, because in 3 months, when you're starting to work on the forms 2 weeks before the March deadline, you're going to ask this question to yourself again. You're not reporting on what actually happened outside of a couple of small nuances in here. If they actually enroll versus not, that is going into this form. But what you're reporting in terms of the offer that you made, the amount they would have to pay, and the safe harbors if you need to use one is not what they actually did. It's what they would have had to pay if they'd taken the cheapest single that you offer. We're not, in other words, we're not using what actually happened outside of whether they enrolled or not. That's the only real exception here. What we're using is the cheapest single. What would it have cost them to enroll in the cheapest single that you offer? Not the full family plan, not could they enroll their kids and spouse and pay for it themselves, not what was the board willing to pay for, right? The cheapest single plan is what we're using. And we'll talk more about that, but I just want to keep emphasizing that part of it, because every year I get the question of, well, Bobby, do I have to report it differently? These ones took the high deductible and these ones took the PPO. And the answer is no, they should all be the same because we're using the cheapest single plan for everybody. Okay, so now we're drilling down even further. This is the most nuance we'll use here, but we're gonna go through in this part 2 of the 1095C each of these lines, and if this is a repeat for you, in excruciating detail. So the first thing is that we're gonna start with here in the part 2 of the 1095C is line 14. You'll notice if you actually look at the descriptor, it is the offer of coverage. Enter the required code. So that's the one where we're signaling to the government, this is the type of offer we made. It met the qualifying offer standard. It didn't meet the qualifying offer standard. We didn't offer anything. This is the line where we're making that clear to them for each month, or if it's static, then we can put it in all 12 months. You must, again, have a different code if even one of the months is different, and you can't use the all 12 month box. The question of the offer means who could enroll, not who you will pay for. We'll talk about why that is hugely significant, but we get this question every year. Bobby, we say to the paras, we will pay for full single insurance. That does not tell me the full extent of the offer to that para. My question back to you is going to be, yes, I know what the board will pay for, but if that para won the lottery and said, I also want to enroll my spouse and my kids, would you let them? It's a pain in the butt to do the payroll deduction. For a lot of those paras, the cost of the insurance outpaces what they make for the year. So now they're cutting you a check every month. The government doesn't care, right? The government wants to know not just what you would pay for, but who else could enroll. And we'll talk about why that's significant here when we get in the codes. So what is your offer? Not what the board would pay for, who could they enroll? And we'll get into that. There's a difference between offering to all dependents and the employee can pay for it, or telling an employee, no, even if you want to, we're not gonna let you enroll your spouse and dependents because I'm not gonna hassle with you writing me a check every month. I get the sentiment. That's not a good approach from the Obamacare perspective, right? So not many of them are gonna take you up on that, I'm guessing. But we have to say to the government, sure, we agreed to pay the $7,000 for the single, and if that para wanted to pay the $13,000 difference to enroll his or her family, we would have let them. That's what we have to be able to say to the government to use the better codes, right? So be thinking about now if you can answer that question honestly. Make sure that you haven't told a para in the last year, no, you cannot enroll your family. We're only going to let you enroll in the single. So if the district offers full family to Tomcat teacher, who's a single guy, never been married, and the district offers only full single to Connie the cook, Tom has no family, so he only takes the single. Connie has a spouse and kids, but doesn't want to pay for them, right? But our offer to Connie was a full single. Our actual offer to Connie was not that that's all you can enroll in. It's just that that's all we'll pay for. Connie could have enrolled her spouse and kids. So could have Tomcat teacher. He doesn't have any, she does. The difference between what we're willing to pay for is not the same thing as what we're offering to allow them to do if they make up the difference. Keep the offer separate from what the board will pay for. That's the biggest part of this. And I'm telling you, every year there are schools that get this confused. I get why. But when you start reading those codes 2 or 3 months from now, you start to, your eyes kind of cross because it's like, well, it looks like this one applies because we only offered insurance to the employee. We didn't offer it to, no, you offered to pay for the employee, but you offered it to their full family, right? That's the difference. Okay, line 14. What are the codes? We're going to go through these one by one. 1A, the one that you'll remember, this is your friend. This is the best one that you can. If you can use 1A, we should use 1A. This is most of your staff. If we offer full family insurance to our teaching staff and administrators, you're going to use 1A. If you offer full single to your paras, you're going to use 1A. This is the code that if you can use it, you should, because it means you don't have to fill out line 15, And it's the one that signals basically that we made the best offer that we could have to these employees. To be able to code line 14 with 1A, it must meet minimum essential coverage and minimum value. And again, if you're using EHA, it does. That's one of the things the Blues help us with. It's a great benefit because some employers are sorting through whether they actually have this as part of their plan. We have the luxury of getting to assume that. You must offer to spouse and dependents. Do you see now why that last slide was so important, right? Because if you cannot say, yes, Connie Cook, you can enroll your spouse and dependents, you just got to come out of pocket to pay for it, then you can't use this code. Even if the amount that Connie would have had to pay toward the single is 0, you can't use 1A if Connie couldn't have voluntarily enrolled and paid for her spouse and dependents. And again, it's based on the cheapest single plan offered, and that plan cannot cost more than 9.86% of the mainland single FPL as federal poverty line for 2019. This is different than the affordability calculation. What this is saying is the government isn't even going to pick this form up again to look at the employee's household income. If we can tell them that the employee didn't have to pay any more than 9.86% of the single federal poverty line. So for 2019, the single federal poverty line is $12,490. 9.86% of that is $1,231.51. That means as long as you don't ask any employee that you're reporting on to pay more than $102.63, you can use the 1A offer code. Example, we offer our paras full single insurance. How much do they have to pay on the 1095C form? 0, right? You get to use the 1A offer code because compared to 9.86% of the single federal poverty line number, they have to pay $0. Bobby, we ask our paras to pay $100 a month toward the cost of insurance. What offer code are you using? 1A, because they still have to pay less than 9.86% of the single federal poverty line. Bobby, we ask our paras to pay 15% of a single. Do we get to use code 1A? It depends. How expensive is the single? What is the monthly amount that para would have to pay? If your para has to pay $102.64, guess what? You don't get to use the 1A offer code. We're going to have to use a different one. If it is $102.63, you get to use the 1A offer code. That's the difference here, right? So if you have a system that requires the employees to pay nothing toward the cost of the single, you're going to get to use the 1A offer code, right? Unless you made some mistake in saying you can't enroll your spouse and dependents. If you tie it to a percentage or to a strict dollar amount, you might not be able to use the 1A offer code if in any month they had to pay more than $102.63. This is where planning for Obamacare compliance and coding in the future is different than the reality. Remember, we're looking backwards. How much did you ask somebody to pay for the 1920 and 2021 coverage year? When we're here next December talking about the 2020 reporting year, those numbers are going to change, right? We already talked about the percentage changing. The single federal poverty line is probably going to change, but we don't know that. So you're taking a bit of a risk, right? At this point in figuring out every year, how much are we going to ask you to pay for the new plan year? But for our reporting, and from a planning perspective, that's pretty easy to figure out. From a reporting perspective, we know what the 2019 single federal poverty line is. We know what the percentage is. Therefore, we know what the monthly amount is. That's the cutoff for the 1A offer code. Got a chat question here. Oh yes, great question. Is the monthly amount healthcare only or is it dental? This is healthcare only. I should have put that in the slide because somebody asks it every year. PPACA Obamacare is based on the health insurance premiums. I know that that's coupled with dental for EHA purposes for the most part. We're talking only about the healthcare premiums. And again, it's not what they actually paid. Even if they enrolled, it's what they would have had to pay toward the cost of the cheapest one, right? So remember that. If you're thinking, oh crap, those employees would have to pay $110 if they get the PPO, even though it's only $95 if they get the high deductible. We're reporting on the high deductible plan. We're reporting on the cheapest single plan that they could enroll in. Okay, so that's 1A. And again, when we get to the forms at the end, I hope this will all kind of synthesize and tie together. But 1A is the best thing you can do for a lot of reasons, which we'll get to. But that's the one that says the government really isn't even going to pick this up and look at it. That's a qualifying offer. It's better, right, than the affordability and unaffordability line, which is 9.86% of their whole household income. So the government is saying, if you can make sure that they're only paying that percentage of the federal poverty line, you can code with a 1A qualifying offer. 1B, and this is where it gets confusing 2 months from now or 3 months from now, offered minimum essential coverage and minimum value to only the employee. Check for understanding, right? If you say to Jane Doe, the para, or to John Doe, the para, yes, we'll pay for the single insurance, but you can't enroll your spouse and dependents, you can't use 1A, right? Because you didn't offer to spouse and dependents. So the only code you can probably use then is 1B, because we didn't offer to them. But don't confuse what you offered to pay for with who they could have enrolled, because you're not going to use 1B if that employee could pay out of pocket for their spouse and their dependents. Have you ever said no to an employee trying to enroll spouse and dependents? If you have said no to some employee, I recommend that we talk, decide why we shouldn't do that, even though it's a huge pain in your butt to collect that money. I get it. I want to save you work here. But what I'm telling you is this notion of, yes, of course you could enroll and pay out of pocket if you want to, is important for Obamacare compliance purposes. Did you offer to only the employee and dependents and not the spouse? That makes no sense. Did you offer to only the spouse and not the dependents? That also makes no sense, right? Well, yeah, sure, Jane Doe, we'll let you enroll you and your spouse because you make $12,000 and it's going to cost 11, so I don't have to get a check from you every month. Short of saying something like that, you're probably not going to use 1C or 1D, right? Don't say to Jane Doe, you can only enroll in as much insurance as your paycheck or as your W-2 would be worth. If you've done something crazy like that, maybe one of these 1B, C, or D codes will apply, but for the most part, hopefully you're not even thinking about using any of these codes. 1E, this is the one that if you ask people to pay more than $102.63 in any month, you're going to be using 1E. Hopefully this is sort of ringing a bell for all of you who have been through this before. 1A, we use if we can. If they have to pay $102.62 in a month, we're using 1A. But if they have to pay $102.64 in any month, we're probably using 1E. This is the one that says we offered minimum essential coverage and minimum value, right? We're not talking about affordability here anymore. We offered MEC and MV to the employee and a spouse and dependents, which is correct if we're doing it the right way. But we made them pay an amount that was more than $102.63. So therefore, we have to tell the government that we can't use 1A. So this is the code that most schools will use. If you're using anything other than 1A and 1E to somebody that you made an offer of insurance to, let's talk, or call your school attorney, because my bet is if you offered them at least some insurance, it should be either 1A or 1E. So example 1, the district pays full single to Peter Para and allows him to enroll his spouse and dependents at his own cost. Which code are we using? 1A, because the cheapest single plan, we paid for all of it, right? So Peter's cost was 0 per month, even though his assumed cost, if he wanted to pay out of pocket for his spouse and dependents, we would have let him do that. Example 2, the district requires Peter Para to pay half of the single premium. Let's say that's $3,500 or $291 a month, $67 a month, and would also allow him to enroll his spouse and dependents. Which code are we using? 1E, not 1A, right? We're using 1E because, yeah, Peter and Peter's spouse and Peter's dependents all could enroll, but they had to pay more than $102.63 in the month, or at least in 1 month, but probably in all months for Peter's sake. So now we're going to have to use 1E instead. 1A and 1E are going to be the ones you're using most of the time. Again, if you've offered insurance to that. We'll talk when we get into the later codes about we didn't offer insurance because they didn't work here then. We'll get to that. If we've offered somebody insurance and you're using something different than 1A or 1E, take a step back and think through it again, because there may be something off on that. 1F is something we don't have to worry about because we have EHA. We offer minimum essential coverage, but not minimum value, right? That's not something we have to fret with, which is, again, an awesome thing. 1G is non-full-time employees enrolled in a self-insured plan. The handful of schools that self-insure in this state may have to think through whether 1G would ever apply, but anybody who's on EHA, Blue Cross Blue Shield, isn't going to have to worry about it because we're not self-insured, we're fully insured. 1H, this is the other code that you will use fairly often, even if you're also using 1A, right? 1H is no offer of coverage for that particular month. It applies if the district did not offer any insurance and that employee was full-time in that month. This code includes months when the recipient was not an employee. So the new teacher that we hired that doesn't start until August, in January, right, through July, if we allow them to enroll day one, or through August if they don't start till September 1st, that teacher is going to be 1H when they weren't even working here, right? They're going to be 1H from January all the way through the month where we offered them insurance. We'll talk about how to code the month of August when they say, yes, I want to enroll, but they don't get to start until September. That's a different box in it for a different time in this presentation. 1H is we didn't offer them insurance that month, and here's why, right? And we explain that in the later boxes. If you have somebody who is on COBRA coverage, you're using 1H because even though they're COBRAing, you're not offering them insurance. This happens fairly often, right? Bobby, our offer to them was this. They went on COBRA. Nope, 1H because that's through COBRA, right? That's not through us as the school. So that's 1H. We'll use some examples of that. 1I, right? The 1I code is reserved. That used to be transition relief. Remember back in the day when we had transition relief? Yeah, all that stuff is gone, has been for several years. They just haven't taken it out of the form yet. 1J is minimum essential coverage and minimum value to the employee. That is a conditional offer. Conditional to the dependents and conditional to the spouse. Again, schools aren't probably going to use this. Who does have to use this are employers. You may have some of these employers in town, right, that are saying something like, you can only enroll in our insurance if your spouse doesn't get an offer. So if the local grain elevator says, yeah, man, this stuff is really expensive. If your spouse works for the school, you got to take that stuff. We're not going to let you enroll. That is a conditional offer of insurance. There's something that has to be satisfied before we let you enroll, right? For schools, we don't have that. We have an open enrollment period. If we're offering you insurance, it's because we're saying you're full-time, or even if you're not full-time, we've decided to still offer you. There's no contingent upon their spouse not getting an insurance offer through the grain elevator. Now, some schools did ask about using this system like that. I think the answer is it's lawful, right? But I don't think any school is probably going to use 1J or 1K on a reporting basis unless you truly have some weird conditional setup like that. But because other employers in town may have that, it could be causing some confusion for your employees who look at their form and say, well, this looks different than my husband's. Yeah, because they worked for this employer that had a conditional offer of insurance. Not your problem, but most of the things that aren't your problem in the school become your problem, right? Well, how much should I put into my 403B? I don't know. Why are you asking me? So anyway, that's just the bookkeeper, business manager. That's part of what you get whether you signed up for it or not. Again, you're probably not going to use this stuff very much. It will create some uncertainty among employees. The questions I get are not whether we should be coding these, but it's that the husband came in with the para, or the wife came in with the husband, that's our employee, and says, hey, we got this. Can you tell us what this means? This is more just so you have some idea of how to foul off that pitch. If it says something like, well, yeah, we got an offer and it's conditional, and we got turned down on healthcare.gov, and that's really where it causes, those are the calls that I get. So if you get a 1J, if you think you're going to use 1J or 1K, call somebody. You probably don't have to, but you could get questions about it. Okay, that's all for line 14. Those are all the codes, right? And we'll talk more about them in the samples. Looking ahead, do you have any idea what the federal poverty line will be for 2020? Great question. When we're doing reporting, we're looking backwards, so we have perfect information. We know what the federal poverty line is, and we know what the percentage of affordability is, right? We know all that stuff. So this person that asked the question of what will the federal poverty line in 2020 be is really saying, how much can we ask people to pay on a move forward basis? The short answer is we're not going to get the 2020 federal poverty line number until sometime in January, February, or March, probably. It's been as late as March before. I hesitate to go into this too much, but here's what I will tell you. Obamacare has an answer for when you know what the percentage is going to be in 2020, but you don't know what the federal poverty line is. And the answer is you can use the federal poverty line number in place with it. That is the one that's in place within 6 months of the start of your plan year. So if you're planning for how much can we ask people to pay in the future, you can use the 2019 number. Some of you are saying, I want to wait for the 2020 number because if it's higher, we can ask them to pay more. That's fine, right? But that's a risk that you're taking because we're not going to have perfect information on 2020 until we know what the single federal poverty line is, and we already know it's 9.78% for affordability. So if you want to talk planning, right, call your school lawyer because there are rules that help address that. But for our reporting purposes, we're looking backwards. All right, line 15, right? So we did line 14, that's the offer. Line 15 is how much money did we ask them to pay? Bookmark this, footnote it, highlight it. If you are checking 1A, if you're using 1A in line 14, you don't put anything in line 15. I'll say that again. If you're using 1A, you don't put anything in line 15. Similarly for 1H, right? If we didn't offer them insurance and there's no amount in line 15, they would have had to pay for the cheapest single. The benefit of putting 1A is, even if we ask the employee to pay $102.62, we still don't have to put that in line 15 because the 1A offer code allows us to skip line 15. However, if we ask paras to pay $150 a month, then we're going to have to use code 1E, which is going to require us to use line 15. So if you are coding 1E because you can't use 1A, you have to fill out line 15. There are rare cases, like the case where you tell the para, no, you can't enroll your spouse in dependents, where you might have to use 1E, but their dollar amount is still zero, right? So that's not to say that you can't have a lower dollar amount in line 15 than $102.63, but that will be super rare. If you think you're putting less than $102.63 in line 15, step back and think about that again, because chances are you should be using the 1A offer code, right? But there are certain weird circumstances where it could happen. I just footnote that if you find yourself using code 1E and putting less than that single federal poverty line number, step back and ask whether you should be. This is what the IRS uses. This is what that ELF that the IRS uses to compare what the employee said on healthcare.gov and what you have said you offered them and what it cost them, right? So it's really important to get line 15 correct, especially if how you got to the amount that they can pay is purposeful, right? If it's because we don't want to owe a tax penalty, getting that number right, that number is what the government's going to use to decide affordability. You're reporting what it would have cost them to enroll in the cheapest single plan that you offer, not the plan that they enrolled in necessarily, right? Again, just to highlight that part of it. If you offer the dual choice, the $1,050 deductible or the $4,000 deductible, you're putting in the amount in line 15 that they would have had to pay if they took the cheaper of the two plans. The single insurance, cheaper of the two plans. Again, regardless of how many they have in their family, we need to offer to let them enroll their family. But regardless of how many they have and regardless of whether they actually enroll, that's what the government wants to know. Because, and it makes sense if you step back and think about it, you're only going to owe a penalty if they don't take your insurance, right? So that's why the government has to know what it would have cost them for purposes of figuring out the penalty stuff. And again, line 15 covers 2 plan years. So unless you keep the amount they owe static, you're probably not going to use the all 12-month box. Because once the premiums increase from August to September of 2019, right, which they did and which they will in August to September of 2020, the amount they're going to have to pay is probably going to change, especially if it's tied to a percentage basis. And it might change because you know the federal poverty line number is going to change too, right? There are a number of reasons, but unless it's the exact same amount throughout the entire calendar year, not plan year, you have to put the amount in each month. And we'll look at an example of that too. There is some good news, which is this. The instructions allow you to annualize the employee's required contribution each plan year by taking the total employee cost over the plan year divided by 12. This is done on a per plan year basis, and this is actually a change, the one big change from the last couple of years. So in your handouts, this is wrong. Circle this, star it, highlight it. We'll put these new slides up there, but I was reading through this just yesterday again and caught this. You can only annualize on the plan year basis. You cannot annualize on the calendar year basis. You see why that's significant? We ask paras to pay during the 9 months they work so that we don't have to collect checks from them in the summer to pay their share of the premium. We can take the September through August amount that we collect, that we expected them to pay, and even if it was different in each month, we can annualize it, which is nice, right? Because then that means you don't have to put 0 in July and June and August, whereas you're putting 212 in the other months. It could be that you actually get to use the 1A offer code now that you can annualize it, but you wouldn't have before if we had to report it accurately for the 9 months we collect. Each plan year, you can take the total amount we expect them to pay and divide it by 12 and put it in here, right? That's super helpful in my opinion, because it makes it so that you don't have to go through and actually look at the exact amount for each of those different pay periods or each of those different months. You can go in and put the total amount divided by 12 through the plan year. Our problem, of course, is our plan year is not on a calendar year. So even though it's great that we can do that for both the 18-19 and 19-20 plan years, those numbers are still going to be different, so we still can't use the all 12-month box, right? Depending on how you charge them. So double check. Always double check. Anytime you're filling out line 15. For 2019, if you're putting less than $102.63 in any box, you've done it wrong, right? That should be a 1A qualifying offer outside of a few very, very rare exceptions that I've only had a couple of times over the last 5 years. If you're ever putting $100 into line 15, ask yourself, should I really be coding line 14 with 1A and not have to fill out line 15? Always double check your line 15 number. Cash in lieu, we're going to hit on fairly quickly. We do this every year. Here's the short answer. If you have a cash in lieu system, you have to have the employees sign what is called an eligible opt-out attestation form, or we have to get reasonable proof that they have qualifying insurance outside of the school. Here's again, we're going to cover this quickly because I'm already running out of time here. But the IRS takes the position that if you charge somebody cash in lieu and they have to make the decision between taking your insurance or taking the cash, they're giving up the cash amount to take your insurance, which means their actual cost is both, right? If I have to pay $100, $90 for the insurance, but I could get a cash in lieu amount of $50, but man, I need the insurance. The government thinks then that's actually a $140 a month cost. Because not only do they have to pay the 90, they're giving up the 50. So you have to code it that way unless you have what's called an eligible opt-out arrangement. So there is a way to do cash in lieu where it doesn't impact your reporting, but you have to make sure you do it the right way. If we offer straight cash as wages in a cash in lieu, we have to make sure that we get the eligible opt-out arrangement, which I will define here in a second. If we put a certain amount of money into a 125 plan for an opt-out, that could be yet a different answer depending upon what that employee can do with the money in the 125 plan. Generally, if they can pay the cost of their insurance premiums with an amount you put into a 125 plan, that doesn't necessarily count as cash in lieu. There are still a handful of you out there that are called flat salary schools. I've worked with several of you every year on this issue. It hasn't gone away. How you treat your cash in lieu system, or how you treat we're putting a flat amount into a 125 plan and you can pay premiums with it if you want to, is again dependent on the conditions and authority of what they can do with that amount when you put it into the 125 plan. So if this is not you, if you don't have a flex or 125 plan, feel free to ignore this part. If you do, and we're using that as a vehicle to funnel cash in lieu or to funnel a flat salary into, make sure you got your arms around this or call your school lawyer to figure out how that's going to impact your reporting. If you use cash in lieu in any form, and it could otherwise qualify as an eligible opt-out arrangement, the employee must provide you reasonable evidence that their entire tax family is enrolled somewhere else that has insurance that meets the minimum essential coverage and minimum value requirements. We get the benefit of assuming that under EHA, but that doesn't mean the co-op's insurance or the Dollar General's insurance or whoever else they might work for in town have insurance that we know meets these requirements. You can't give somebody the cash in lieu though, unless you know that that's true. That's where it becomes difficult, right? How do you know if somebody brings in their insurance plan, whether it has minimum essential coverage, minimum value? You're probably not going to, right? That's why we are allowed to accept from the employee what's called an attestation form. So we have to, number one, provide reasonable evidence the employee's entire tax family is enrolled in qualifying coverage. Number two, we have to make sure that that coverage is not from healthcare.gov or from an individual marketplace. Reasonable evidence can include an employee attestation form. So if this is super confusing to you right now, sit back in your seat, take a deep breath, and hear me on this part. If you have cash in lieu, you don't have to collect copy of their insurance card, copy of their plan. You can have them sign an employee attestation form or provide proof of enrollment. You can do both, but you don't have to. So our recommendation for schools that use cash in lieu is to have this employee attestation form that you use, which has them assert all of these things are true. That puts the risk on the employee. That says if we find out you're lying and you don't have your tax family enrolled in your spouse's coverage at the co-op, we don't pay you the cash in lieu anymore, right? Because we can't pay you the cash in lieu without it hurting our reporting unless we know that we have an eligible opt-out arrangement. You have to receive that form every year within a reasonable time period close to the proximity of the start of your plan year, which the government says, and I quote, should be within a few months of the start of your plan year. We have, Bobby, we have cash in lieu. Recap what you just talked about for the last 5 minutes because I'm confused as hell. Totally understand. We have cash in lieu. If you do, you should have an attestation form the employees fill out. That attestation form should include that I don't have my insurance through healthcare.gov, that my entire tax family is covered, and that it's qualifying insurance, right? And we have to get that form from them every year. We can't have a ditto mark, right? Every year we're going to pay the cash in lieu because every new year is a new Obamacare reporting year. Every year we have to get this attestation form within a few months of September 1st, the start date. So in August, you can say to all your cash in lieuers, I need this form back or you're not getting the cash. That's how it has to work. So that will have collective bargaining implications and all that. I get that. If this is confusing to you and you want to talk through it, let me know. But if you have cash, you're not using the form, that could impact your reporting. If you don't have cash, feel free to ignore the last 5 minutes. Okay. Yeah, if you're required to report cash in lieu, right? If we don't use this form, if we have to account for that cash in lieu and it's more than $102.63, again, you know that you have to use 1E and you can't use that 1A offer code. That's where this cash in lieu can hurt you, right? Is it can make it so that you may be subject to penalty, even though your insurance is otherwise affordable, but for having to count the cash in. So that's why it's important to get that right. Okay, line 16, and then I promise we'll take a break. This is where the only part of reality sets in. This is where we tell the government, did the employee enroll or not? And it's where we tell the government, we have met a safe harbor, even if we have to use the 1E code in line 14 and put a dollar amount in line 15. Line 16 is where we ask for our transition relief, the W-2, the federal poverty line, which doesn't make sense because of the 1A offer code, and then the rate of pay safe harbors we talked about earlier. That stuff goes in line 16. Generally, this is the line where you justify not having to pay a tax penalty. However, and this is a question I still get every year, in many cases, line 16 will be blank. If we offer full family insurance to a teacher that does not enroll in our insurance, we're probably not going to have anything in line 16, and that is totally acceptable. All of you good rule followers out there hate that the boxes aren't perfect and that some of them are blank. And I get that. But it is entirely possible that for a significant number of your staff, line 16 will be blank. Blank in line 16 is just as good as any of the coding in a lot of the cases that you're going to deal with regularly. Good example, we have a 1A offer code in line 14, which means we don't have anything in line 15. And if they don't take the insurance, line 16 is blank. We're not going to pay a penalty because we have a 1A offer, right? But the government knows they didn't enroll because we have a code for if they enroll. So what you're telling the government is, these folks, when you look at our schools or our ESU's report for them, they must have enrolled someplace else. So we should be looking for a different 1095C that applies to this family. We should be looking for their insurance company filling out the B forms because they didn't get it from this employer. If there are two employers involved, right, one of them, if they're covered by Obamacare and the family enrolled in one of them will have that they enrolled and one of them will have that they haven't. So it's very natural that this line is blank, even if we made a great qualifying offer to them that they didn't take. You must use only one code per month. And again, unless all 12 months applies, which is possible in these cases that all 12 months applies, we'll look at that. And there is a hierarchy when more than one code could apply. So if you have somebody on COBRA, right? Or if you have somebody who's in a wait period, like a new teacher who enrolls, but it's August, right? And they don't start their insurance until September. Now they've enrolled, we've made them the offer, but they're not yet getting coverage. There are different codes that could apply there, and we'll go through the hierarchy for when they may overlap. And again, there's no more transition relief to worry about. So I think we have a question here. is money into the employee's HSA cash in lieu. If, for example, we have the option of enrolling in the $1,050 deductible and we'll pay the single, or you can enroll in the high deductible HSA plan and we'll put the difference into your HSA. Very common arrangement. I think EHA and Blue Cross say you have to do that. I disagree with them. Unless that's in their underwriting rules, it's certainly not required by law. I get why they would want you to do that, right? But if you are just saying you can enroll in either of these, but we'll put the difference in an HSA, that is not a cash in lieu. Because what we're asking is how much would they had to pay toward the cost of the single premium, right? That answer is going to be whatever we would charge. And it's probably $0 if all we're doing is putting the difference between the two plans into the HSA. However, if what we're saying is all paras get $10,000 into an HSA or a flex plan or a 125 plan, and then with that, they decide what to do, including they can cash it out, right? That's like a flat salary type of arrangement. That may or may not constitute cash in lieu, right? So if you're one of those schools, you have to talk to your school lawyer about it. Unless you've got it figured out from past years, that's entirely possible. But if we're just putting in the difference into an HSA, that's not a cash in lieu system under the Obamacare rules. I can see how it would look like that, right? Because if you take the more expensive plan, you're not getting any cash into an HSA. That's true. But this is part of Obamacare. We're not talking about reality. We're talking about what it would have cost to enroll in the cheapest single plan. Good question. Okay. Keep them coming. We're going to breeze through line 16, then I promise we'll take a break. Okay, so what are the codes for line 16? 2A is a code that you'll use fairly often. That teacher that doesn't start working for the school until August is 2A in line 16 and 1H in line 14, January through July, right? Because they didn't get an offer of insurance because they didn't friggin' work here. So 2A is they didn't friggin' work here. They didn't register 1 hour of service in that month for us. 2B, as the employee did work for us, but they were not full-time during that month. So it is entirely possible, right, that you're going to have somebody like a substitute that works for you regularly, who subs a couple of days a week, but then starting in March takes a long-term subbing for a maternity leave. That person is probably going to be 1H in all those months because we're not offering that sub insurance, right? But in a lot of the months, they're going to be 2B because they weren't full-time. And then it's possible that when we get to those months where they were full-time because they were a long-term sub and they worked 140 hours for that teacher, line 16 may be blank. We're probably not going to get penalized for that person, right? Because on the look-back aggregate, we didn't have to offer them because they aren't full-time on average. But they were full-time in a couple of those months, which means we must pay them, or we must give them this form. So we'll talk about those examples and I'll answer your questions. But 2B is yeah, they were working for us, but they weren't full-time in that month. This would include, for example, the employee that you fire on February 2nd, right? In January, they may well be 1A and 2C because they enrolled in your insurance. In February, they're going to be probably, right, they worked for a day, so they're going to be 1H but 2B because, yeah, they worked for us, but they wasn't full-time and they didn't get insured in that. But you know, even though they had insurance that first day, it wasn't for the balance of that month. So there are some weird circumstances where you may use 2B. Far more often, though, will be when you're using 2A. Because if you have an employee who's 2B in every month, guess what that means? They probably shouldn't be getting a form because they're not full-time, right? Okay. 2C is the employee is enrolled in coverage each day of that month. This is why you can't use 2C in August for a new teacher. But you can use 2C if your 10-year vet who's always taken full family insurance doesn't change anything for either of those two coverage years. Your most common form of the 1095C forms is probably going to be your teachers, 1A, blank in 15, 2C if they took your insurance in line 16. That's probably the most common form that schools and ESUs will fill out. 2C is they enrolled in coverage. 2C applies, right, before any other code. So if they take COBRA, it's 2C, or it's not 2C because they're not enrolled in your coverage, right? That's 2A because they don't work for you anymore. 2C is the one that you'll use if you ask each employee to pay $150 a month. Check for understanding. Can you use the 1A offer code if you ask them to pay $150 a month? No, because it's more than $102.63. So you'll have 1E, $150 a month. But if they enroll, if they say, I'll pay $150 a month for single insurance, right? That's still 2C. So we use 2C ahead of any safe harbor code, ahead of anything else. This is the only time the government wants the truth from you. Did they enroll? If they enrolled, you always use 2C, even if it would have cost them money, even if it's not a 1A offer, right? If they enrolled, put 2C in line 16. 2D is what we're going to use, what's called a limited non-assessment period. 2D for EHA purposes, since they can always start on insurance the month after they begin, right? At least unless you have them start earlier, which could happen. But you're still probably going to use 2D if for any new teacher. You're going to use 2D for any new para that you hire October 27th that starts insurance November 1st, right? Because that month they worked for you, but we're going to use 2D even ahead of 2B, because 2D is where we signal to the government, yeah, this is just our wait period. They call that a limited non-assessment period. A better term for it is a wait period. Same thing for mid-year hires, new hires where we're not sure if they're going to be full-time or not. This would be used in August for that new teacher, right? We don't know if was that teacher full-time in August. If they reported on August 10th, probably. They probably worked 130 hours. So we can't use 2B. We're going to use 2D because that's what signals to the government. They're just in our wait period, right? That's basically what 2D is. 2E is the multi-employer rule. Unless you're McDonald's, this probably isn't going to apply to you. So if you're a school in ESU, this likely won't matter. And then we get the safe harbor codes, right? 2F is the W-2 safe harbor. That's looking at their box 1 W-2. How much did you ask them to pay per month? You can't use the W-2 safe harbor unless it is equal in all months. That's why most schools that I work with, because our premium levels change, right? In the middle of the calendar year, most schools that I work with can't use the W-2 safe harbor because it's not exactly equal in each month. It could be, but what we're comparing is each static month and what that is at the end of the year compared to their W-2. So that's just a little less predictable, but some schools still do use it. 2G is this federal poverty line safe harbor, which again, the 1A offer code and the 2G safe harbor are pretty much the same thing, right? 9.86% of the single federal poverty line. So this safe harbor you're probably never going to use, because if you could use it, then you should be using the 1A offer code. 2H is this rate of pay safe harbor. That's the one where we take their rate times 130 times 9.86%. We figure out, did they pay less than that each month of the year? If so, then we can use this 2H rate of pay safe harbor. Check for understanding. We have an offer that requires somebody to pay $150 a month. Do we use 1A or 1E? 1E, $150 a month. They enroll in our insurance. Are we using 2H because they meet the rate of pay safe harbor, or are we using 2C? Always using 2C, because the government always wants to know if they actually enroll, right? So that's just, again, where you might have to look back through these to get yourself familiar with it. But that 2C, yes, they did enroll. We're going to use as often as we possibly can. 2I, that used to be transition relief, right? Oh, hearkening back to the good old days. If no code applies, leave it blank. We offer the teacher full family insurance. He or she doesn't take it, no sweat. It's 1A blank blank. Not a problem, right? That is totally okay. That is expected to happen. Don't freak out if line 16 is blank. Make sure you've ruled out the codes you could use, for example, if you need a safe harbor, because we asked them to pay an amount that we have to put in line 15. But it is entirely possible, and in most cases, I think for you, lines 15 and 16 will be blank if you have an employee that does not enroll. You do not have to do part 3. That's always been the case, but if you're new to this, you're not filling out part 3. That's part of what Blue Cross Blue Shield is submitting as part of their plan, as part of what they said. Okay, we're going to take a break. It's 11:03 by my count. Let's do 5 minutes so we can get through this stuff quickly and get to your questions in the forms. So we'll come back at 11:10. Send questions via the chat and send me a text message. I'm going to mute us again here, and then we'll be back in a few minutes. Okay, we are back. I do have one question via text, but if you have, again, you've done a great job sending them in. This is the only one I've gotten via text, but here it is. Long-term sub, will this be 1H and blank? Chances are yes, it probably will be, but we'll talk about some more of that as we get through here. Teacher was full-time last school year, but is only an outside coach this year. After September 1st, would it be 1H and blank? Chances are it would probably be 1H and 2B, that they're not full-time, right? It wouldn't be blank, I don't think, because if they are working for you and they're not full-time, I think it'd probably turn from like 1A, 2C to, okay, they retired as a teacher, but now they're a coach. It's probably 1H because we're not offering them insurance anymore, but it's likely 2B because they're not full-time. Husband, wife are both full-time employees. Wife was hired later, was already on full family coverage paid by the school through the husband, so she didn't enroll separately. Should I still mark her as 1A, 2C? Great question. No. Husband and wife are both teachers for the school. Both spouses get a full family offer through collective bargaining. One of them can enroll, right? Unless you're one of these schools that allows them both to enroll in a single plan, which still happens on occasion, especially if you have cash in lieu. But there are places that still allow both of them to enroll on a single plan for reasons I don't understand. What most negotiated agreements say is if you are married to somebody else who gets the same insurance offer as you, only one of you can enroll. The person who actually enrolls is 1A and 2C. The person who does not enroll is 1A blank blank. Right? They got the same offer, but only one of them on an individual basis enrolled. Good question. Keep them coming if you have them. All right, on to the 1094C. I'm anticipating this is going to be 20, maybe 25 minutes, and then the balance of the time is for you to either leave, go to lunch, do whatever you want. But I'm going to run through the forms that are on the website. If you don't want to hear me do that, I wouldn't blame you. I got a real face made for radio, probably just sick of me. But I will also answer any questions you have about unique circumstances that you call it karaoke time. I hope we'll have about 15 minutes or so for that at the end, even if we go through the forms. So we've been through the 1095s. As of at least March 2nd, 2020, right, you'll have delivered a stack of those to all of the employees who are full-time in any 1 month. On top of that stack, and by March 31st, you will provide the 1094C and copies of all those 1095Cs to the federal government. Think of it like a transmittal or cover type of letter that you do for your independent contractors, that you do for your W-2s. This is the here's how many you're getting, and here's some just general 30,000 foot level stuff that we, the school, are providing. Somebody said we are still on mute. You shouldn't be. You should be able to hear me. Does anybody else having trouble hearing me out there? If so, send it in. I'm going to mute and unmute real quickly. I said I took it off mute, so hopefully everybody can hear. I figured we'd have about 60 chats if people couldn't hear. But if you're, Roxanne, if you're alone, if you want to try toggling your volume, and if that doesn't work, give Sherry a call here, 402-804-8000 at our office, and hopefully she can help you out with that. But if anybody else is having trouble, let me know, because it means we may have lost you all. I hope that's not the case. So your 1094C is your cover letter on top of this stack of 1095s that you already gave the employees and you're sending to the government, that their little elves can decide if they have to do anything with them. This is how the IRS makes those employer level determinations. Transition relief is gone, so we're not talking about that anymore. Part 1 of this document, pretty straightforward, right? There's only a couple of aspects of this that I want to point out. Lines 1 through, let's see, 16, that is just the school information. That is going to include, right? Sherry, if you are listening or you can hear me, can you try to get a hold of Roxanne, please, and see if you can help her out? Okay, sorry, Roxanne, I promise I'm not trying to abandon you. We'll have the recording for you as well if we lost connection here or something, but I think everybody else can still hear, hopefully, so we'll trudge forward, and like I said, we'll make sure this is available to everybody as well. Oh, we got a question. All right, I'm going to get through this first part, and then I'll go to the questions here. So 1094C Part 1, make sure that that lines up with what's in Part 1 of the 1095C, right? Because that's where we run into problems if they don't line up. The main things from Part 1 of this form, lines 18 and 20 of the 1095C, or excuse me, the 1094C, should probably be the same unless you are a super, super large school district that is submitting more than one batch of 1095Cs. For example, I don't know how Omaha Public or Lincoln Public does it, but they may have a batch that they send in that's all their teachers, and then a batch that's all their administrators, and then a batch that's all their paras, right? That is permissible. You don't have to send in just one stack of all full-time employees. But if you do that, if you're only submitting one 1094C and one stack of 1095Cs, then lines 18 and 20 will be the same. And it must match up with the number of 1095Cs you're actually submitting. So I have had a school who had a late in the game change and decided that these 3 employees weren't supposed to get the 1095C form. They failed to make that change in the 1094C. So the federal government came in and said, hey, we're missing 3. One of those examples where before we hit submit, make sure that you've figured out how many of those you have and that those numbers in lines 18 and 20 are the same. And line 19 will be checked yes if you're submitting in one batch. So if you're not, Omaha Public submitting in multiple different sets of employee batches, you're only submitting one, you'll check yes. That says to the government, this is all the 1095s you're getting from us, right? If you're doing it differently, you'll check no, but then you have to look at the instructions. There's some other steps you have to take. Most of the schools, even larger schools that we worked with, have tried to do it all in one batch just to make this part easier. 1094C Part 2, this is again where you've got line 20 that should match with line 18 if you submit it all in one batch. And line 21 is likely no for all of you because you're not part of an aggregate group, right? You're not McDonald's or Taco Bell. So you're not part of a larger overarching employer and you're just your own little subsection. You are the employer that's reporting. And again, if you're checking no in line 21, we get to ignore the 4th part of this form entirely. So we ignore the 3rd part, the 1095C form entirely. We ignore the 4th part of the 1094C entirely, and we'll look at that in a second. This is a big one. This is one that more and more schools have started to check a different box from when we started. This one is the certification of eligibility for the employer. This is the one that asks, are you making qualifying coverage offers to people? And did you make a qualifying offer to at least 98% of all full-time employees? So there are only 2 choices here, right? B and C used to be for transition relief. Again, although I'm nostalgic about transition relief, it's gone. You only have 2 boxes that you can check here. You check A, qualifying offer method, as long as at least one of your 1095Cs has a 1A offer code. For most of you out there, unless you are truly a flat salary school that has to check 1A never, any school out there has at least your teachers and administrators that are probably getting a 1A offer, right? If we're gonna pay for at least a full single for any employee, short of a weird cash and lieu situation, you're gonna have at least one of your 1095Cs coded with 1A in line 14. If that is the case, you check box A in this line 22 of the 1094C. Now, what's interesting is, as more and more schools have started to just sort of deal with the reality of offering affordable insurance to more of your full-time staff that are non-teachers. So I've got schools that will legitimately call me and say, Bobby, we offer a full single to anybody that works here that works at least 25 hours a week, right? So Obamacare has the average at 30. But we've got some schools that say, EHA allows us to go down to, 15 or 20, I think even, and you can still offer that person insurance. We have some schools that just say, look, we're competing for good employees. We're going to offer a full single to even, our part-time paras as long as they meet the EHA requirements. If that is your school, if what you're saying is, I've got a good track of who are my full-time staff, and we offer at least a full single to all those folks, we know that we have a 1A qualifying offer to them, almost certainly, right? If you have offered that 1A qualifying insurance to 98% of your full-time staff, you can check box D. For a lot of schools out there, now increasingly so, as we've sort of stabilized in this Obamacare environment, more and more schools are able to check box D. The significance of checking box D is you have to be right, right? You got to make sure that we did truly offer that affordable coverage to 98% of our full-time staff. Because we don't know exactly what affordability is, right? Because it's based on their household income. What I say is, did you offer 1A qualifying insurance to 98% of your staff? If every one of your 1095Cs or at least most of them where we had full-time staff has 98, and that's 98% of your 1095Cs have that in there, then I think you can absolutely check this box. Now, it's not a huge benefit, right? The big benefit of it is where you don't have to fill in part 3, column B, which we'll go look at here in a second when we get to part 3. But really, you can check the 98% offer method, right? Only if you offered to all full-time employees in all months of 2019. So it's a take it or leave it proposition. If you're sitting there thinking, well, gee, Bobby, I put 1E for all of my paras because we make them pay 50% of the single. That doesn't mean you're going to pay a penalty. It doesn't mean you've done anything wrong, right? It just means that you're not able to use the 98% offer method, which is okay. This is just something that if your school has decided we're offering full single to everybody, you can check it. If you can't, you didn't do anything wrong. You're not necessarily going to pay a penalty. Don't worry about it. It's just something that is one of the options to explain, because if you can check it, you should. So when might this be checked? Again, you offer at least a full single to every full-time employee. Paras, custodians, cooks, teachers, admins, everybody. Unless there are any questions about that. I think we got a couple here. I want to make sure we're not getting too stale on them. Okay, question. If I have an employee who resigned, she'll be paid in January for hours worked in December. Her and her family are going on the market insurance as of January 1, per their choice. Instead of getting EHA insurance, get one more month in January. Is that going to be a problem with this reporting next year? It could be. The answer to we have somebody who's quitting, and this is how it always works for teachers, right? If a teacher quits at semester, they've worked 4 months of the year, right? But they probably performed half their duties, but we still have 8 months of pay and benefits that we owe them. So in other words, teachers front load the hours and we back load the pay and benefits. So if what you're saying is we had a teacher who resigned, and technically that teacher is owed for half of her pay for that year, half of his pay, because they worked half the duty days, there is an argument out there from the NSEA that that teacher is also entitled to 6 months of insurance, not just 4, because I worked half my days, right? I believe the response, if you contact EHA, and I don't want to speak for them, but I believe their response is we should not be insuring people who are not employed for us. My first call, if I have that question, my first call, Celine, is to EHA. It could present reporting problems, but I think what you're going to want to figure out first is, is that person actually receiving an offer from us in January or not? Because I think it might not be so much of a legal question as it is an underwriting question. Because if EHA says they're done as of December 31st, I don't know that you can insure them beyond that, right? So that's one of the uncertainties that I have kind of in how these end of employment situations are processed, especially when contractually that person's worked half the time, but we've only given them a third of their insurance benefits, right? So I don't know if you guys have another thought on that, but that's my understanding is I believe that the insurance offer ends when they're no longer employed, because that's how all the underwriting is set up. So if they could have otherwise enrolled in January, I don't know that I would consider that to be true without talking to EHA and the Blues. Really good questions, though. But yes, Celine, put a footnote in that one, or put a star by that employee, because if there's somehow where they do get pay and benefits, like if we have an agreement with them that their resignation's effective January 31st, that means they could be an employee. So next year you could be reporting on that person, even though they were fully and effectively retired and paid out in full in January, right? Because they would have, arguably, it depends on if they're working or not and all that stuff, but it is possible that that will impact your 2020 reporting.
And on this form, you can check 2 boxes, right? You can check
Yes.
A and
Yes. Question here, in this 1094C, right, we're back to line 22. Can you check A and D? The answer is yes. And in fact, I don't think you could check D without checking A. At least I'm not, it'd be a real weird circumstance where that would be possible. Every school in ESU is probably going to check A. There are an increasing handful that weren't really worrying about D, but probably should be now, especially as, like I said, we've kind of settled into this Obamacare structure. But yes, you can check both, absolutely. Check all that apply. Okay, so moving on to part 3. This right here is the biggest reason that schools have gotten those ESRP notices. Star this, highlight it, circle it, put a big smiley face by it, right? Do something. This box right here says, this is your minimum essential coverage offer indicator. did you offer minimum essential coverage and minimum value to at least 95% of your employees' independents? Yes, you did. Doesn't matter if it was affordable. Doesn't matter if we may owe a penalty on it. We at least offered to 95% or all but 5, if you have fewer than 100, of our full-time employees. This is the one that if you check no on accident, or if you leave it blank, the IRS assumes that it's no. This is tied to penalty A. Penalty A, right, that big penalty says, did you offer insurance to at least 95% of your full-time staff? If you check no, that's when you get the $1.3 million bill from the IRS. Now we can clean it up, but if you think that you're checking no, or if you're leaving it blank, you're making a mistake, right? It should either be yes or no, and if it's all 12 months, most likely what 99.9% of schools and ESUs that I work with will be doing is checking yes for all 12 months. If you're doing anything other than checking yes for all 12 months, in column A, line 23, call your school lawyer, right? I'm telling you right now that there's probably some mistake there. It's just getting confusing, but this is the one where you're going to get that nasty letter from the government because of a mistake or just a mistaken understanding of what this is actually asking, and it's not your fault. It's super confusing. So let's boil it down to this. If you're checking anything other than yes for all 12 months, contact your school lawyer. Okay, so that's column A. Let's move to columns B and C here in that last part of the 1094 part 3. Column B, this is the total number of full-time employees in each month. Remember, if you checked the 98% offer method back there in line 22, if you checked box D in line 22, you don't need to do this column. That's the one main benefit of being able to check the 98% offer method. That's really it though, so don't feel bad if you didn't, right? What column B is asking you is to enter how many full-time employees did you have in each of these months. Not FTEs, how many employees under the Obamacare counting rules were actually full-time. This is employees who worked at least 130 hours in the month or who are full-time averaging 30 hours a week during your look-back period. The number of employees that you're considering full-time through your look-back method is your floor, right? And then you've got that long-term sub, and you've got the person who maybe did a whole bunch of activity driving that month. Those weird circumstances where somebody may have hit 130 in a month even though they're not normally full-time. That's really all you're adding on to this column. You do not include employees that are in what we call that limited non-assessment period. So in August, if you had 10 teachers who resigned and you hired 10 new teachers starting in August, those 10 teachers in August are not going to count because they're in the wait period to enroll in insurance. That's one of the weird, quirky rules here. So put a star by that one, highlight that one. Those teachers where you're marking 2D in line 16 of their 1095C form are not going to count as full-time employees. That's how the government basically lines up with what Blue Cross and EHA are submitting that says these people were in our wait period for enrollment. So that's column B is all your full-time employees. Column C is the total number of employees you have. So which column is going to be bigger, column B or column C? Column C, absolutely. Because column C is going to include all of your subs for that month that weren't full-time. All your bus drivers for that month that weren't full-time, right? So you have a ton of total common law employees that are not full-time in that given month. You must track, you do not have to look at day one of the month. For example, if your pay period is the 20th of the month, you can use the 20th of each of those months to fill out these two columns, right? It doesn't have to be the first of the month or the last of the month. You can use your payroll date, which is going to make life a lot easier for you because you're going to know there's a certain amount in your look back period, right? All your teachers and admins, unless they're part-time, are probably going to count. All your full-time paras, all your 12-month staff, they're probably going to be full-time. But using your payroll period will allow you to kind of sift through those that may or may not be full-time in that given month, but they're still employees because they're getting a paycheck from you. We're using the common law definition here. So paras are still employees in the summer. That's why they can't get unemployment insurance, right? They have that guarantee of future employment unless we tell them they're fired. So when you're looking at your total employee count, paras will probably count in the summer in both columns if using the look back method, we believe them to be full-time. Because remember, we exclude from the denominator when we're calculating their full-time status, their employment break periods. So if you have, basically, let's put it this way. If we offer insurance to anybody who's full-time and we have people who remain on insurance in the summer, chances are you're offering them insurance because on the average, they're working 30 hours, right? When we ignore their summer months where they don't work at all. So knowing who counts in column B and column C is something you should kind of think through and work through those rules as you're filling those out. But if you have an employee that subs 1 day a week that is never full-time, so they're never in column B, but they work literally every month of the school year, they could show up in column C 10 times, right? They just wouldn't show up in June and July. So you got your full-time employee count as compared to your total employee count. Knowing that the common law rules, who is an employee of ours as we answer that question on that day, right, is going to apply. So that's why, again, paras who work 0 hours in July could still be considered both a full-time employee and a total employee, even though they're not working, right? Because they keep their full-time status if we've determined that they work 30 hours on average when we do our full-time calculations. That part gets confusing. I totally understand that. If you have questions, we can come back and cover it. But that's the thing to keep in mind there is knowing who we have to count even in months they're not working as a full-time employee and as a total and as an employee when they're registering no hours, right? That's hard. What about this one? What if we have somebody who's a community member who is an assistant football coach? We know they're not going to be full-time, right? And we've hopefully cabined off and tracked their hours to know that they're not working 130 in any month. Otherwise, we got other problems like the FLSA and all that stuff. But if we have a part-time football coach, that football coach is going to count as an employee, right? Probably in the months of August, September, October, November, maybe December if we have equipment checkout, maybe in July if we have a team camp. So thinking about what does that person's pay cover, when are we considering them an employee? They're probably going to go into those columns, right? Because they are an employee that we're paying at that time. However, an employee who works for 6 months or less, like a part-time football coach, is not an ongoing employee. They're a seasonal employee. So the other rule, and I should have put it up here, I don't think I did, is if you have a substitute that you could call any day, right? That person is probably considered an ongoing employee for purposes of filling out whether they are in column C. But if you have a part-time football coach that works 3 months and then takes 9 off and then works 3 months again, that person is only going to count as an employee in those months they're actually working, because they're a temporary or seasonal employee and their clock functionally starts over every year. I will wait for the aftermath of questions if there are any on that. I know this is my least favorite part of these forms, because it's like government. We're sending you the 1095s. Why do you care? Why are you putting us through the ropes of all this? Well, what they're doing is making sure that you're not providing too many or too few 1095Cs, right? This is just a cross-check to them to make sure that you're doing this stuff the right way. But still, it's frustrating. And honestly, in my opinion, these 2 columns are the most confusing of all the stuff that you have to do for this reporting.
So the total employee count is not necessarily how many people you paid that month.
The total employee count is not necessarily how many people you paid that month. That's right. Because
Me too. I know I've done it wrong.
I totally understand that. I don't think the government cares if you do it that way, to be honest. I've never had them question this. But the technically correct answer is the month of July. All your teachers, all your paras, they are still common law employees. That's why they can't go get unemployment insurance.
Okay.
They have an expectation they're going to continue.
Okay.
But your seasonal employees, like your football coach, does not count as an ongoing employee because they don't work for a period of at least 6 months when they take their employment break. So it's really weird. And so it's not just who you're paying. That's what I'm saying. Leave it to the government. If they would just say, how many people did you pay in that month versus how many are PPACA full time, that's easy. But because they say we have to use the common law definition in column C, that begs all these weird questions about what is a para in July? What is a sub in July? What is a football coach in July? What's a teacher in July?
What's the para that works it doesn't work, resigns in July?
Then they're not an employee.
The para that resigns in July is probably an employee through the day they resign. Yeah, it's weird, but they work no hours. I get that. But that's why our work, like I said, our unemployment rules say if you have the expectation of future employment which is to our advantage, absolutely. So that's why I don't want to play too fast and loose with this, because I don't want to, you know, mesh that stuff too much. Okay, question. We're almost done with this form, I promise. Can you explain the sub-employee count one more time? Absolutely, absolutely. You probably have a sub list, right? And normally you start at the top. So you tend to have the person that you call that subs for you, you know, maybe once a week at least, pretty regularly throughout the year. That person, you're probably going to consider an ongoing employee. In fact, some of you send out sub letters still, right? That say to that sub, hey, thank you for subbing for us. We intend to call you as a sub next year. The reason you do that is so they can't get unemployment or underemployment insurance in the summer. Same rule applies to the parents. So if you consider that sub an ongoing sub, and it's just a matter of how often we need them, it's not a matter of whether we consider them on our sub list, I would treat that person as an ongoing employee for a number of reasons, not least of which is we have an argument that if they do 3 maternity leaves in 1 year, right, we can track their hours over the course of the look back period, just like you do for regular employees. So there's a number of reasons why, but I would say any sub that you plan on subbing regularly, I would treat that person as an ongoing employee. They show up in column C even in July. If you have somebody way down on the bottom of the list that you literally never intend to call, and we can't evidence that we call them more than once every 6 months, they're probably not an ongoing employee. So it's not a hard and fast rule, right? But if I'm talking subs, anybody who's going to be a regular substitute for us, who's never going to be full-time, they're not going to show up in column B, but we generally consider them an ongoing sub for us that we're going to use regularly, I would put them in column C. And the answer isn't because the government has clear rules on this. It's because I want to be able to use that to our advantage in other contexts, like unemployment, that sort of thing.
Okay, so if you use the 98% offer method, you don't have to fill out column B.
Yes.
You still have to fill out column C.
If you use the 98% offer method, you do not have to fill out column B, but you still have to rack your brain on who is a common law employee in each of the months in column C. Huge pain, I totally get it. The amount of value that this has relative to the time that you're probably gonna spend thinking on it is really small, because the government, at least not any time that I've had a school that got an ESRP or a penalty notice, they've never even looked at this. It's never even been brought up. But it does show up in that ESRP table that we talked about in those penalty letters. This information shows up in there. So they look at it. We can't just fluff it off, right? But we do know that they're not really focusing on this column B and column C overall, but we should still do it right because it is showing up. And this is what helps them understand if there's an imbalance between the number of 1095s we reported versus our total number of employees. That's when they may come in and do an actual audit and say, hey, you clearly can't be computing this or calculating this stuff the right way. Okay, keep questions coming, but I want to get through this part because I want to be respectful of your time here. 1094C Part 3, column D is the aggregate group indicator. You are likely not going to use that. So don't worry about column D unless you really do think that you are going to submit in multiple batches, or if you're part of like a joint employer situation. If you're a McDonald's, sure. I don't know of any school or ESU that's going to have to worry a lot about it. If you think if this may apply to you, I would check with your school lawyer because the rules are kind of funny. Column E, that's where we used to put our transition relief. Oh, so many relics. Totally reserved and not used at this point. We do not have to fill out Part 4. Put a big cross through that. Don't have to do Part 4 whatsoever. And we've done it. We made it through all of this stuff. I'm going to get to going on the forms here because I want to try to get you out a couple minutes early and or to answer specific questions you have. Text them, shoot them in. That's it. We made it through the forms. If you haven't gotten up and left, if you're not drinking yet, good for you. We did it. So if you know this stuff and walk away right now, my hope is you're most of the way there. If you're going to get up and leave, I don't blame you. All the samples that I'm about to go through here, I have been provided to you in the link that Sherry sent. There's some other stuff. For example, there's a copy of these instructions, right? That's in there. I've got a couple of the notices. For example, the notice that extended the 1095 deadline from January 31st to March 2nd. That actual IRS document's in there. The one that talks about the affordability numbers, right? The 9.86% for 2019, the 9.78% for 2020, those are both in there so that you've got that in one cool, dry place if you want to refer to them later. All of these sample forms are at the link. I'm going to go through them here pretty quickly, hopefully in about 5, maybe 10 minutes, and then have 10 minutes for any other questions you have. If you want to up and leave, totally go for it. Okay, real quick, one question here. This is going back, but I have a question on the 1095. I have substitute parent who became a full-time parent in August, then quit in September, and went back to subbing. What safe harbor code should I use for her? It's going to depend on, did you make any offer of insurance? Because if you didn't make any offer of insurance, then you're not going to use a safe harbor code, right? If you made an offer of insurance in that 1 month when they planned on going full-time, if that was only August and then quit in September, maybe that person was never actually on the insurance. So you could have a wait period month, that August, where you thought they were going full-time and then they decided, not for me, and went back to part-time. The question is going to be, does that person even get a 1095-C? Did they work a full-time amount in August? Because if they didn't, even though you were planning on them working over 130 hours a month, if they didn't get to full-time in August and they weren't full-time any of the other months, they don't even get the form. So I would start there. That's question one. And any month where you didn't offer somebody insurance, you're not going to be using a safe harbor, right? Because there's no amount that you're comparing that to that they would have had to pay toward the cost of the cheapest thing. Okay. So first, the 1094-C, and this is going to be hard to see. Like I said, it'll probably be easier on the form, but what did I check here? If you are looking at the 1094-C for any school, you'll notice that in line 19, I have 75, and in line 20, I have 75. Is this the authoritative transmittal in line 19? I've checked yes. So those numbers, 18 and 20, should match up. That should also be the exact number of 1095-Cs that I'm submitting with this document. Line 21 is the ALE member and aggregate ALE, part of an aggregate ALE group. I think for almost all of you, that's no. And then this particular school in line 22 could only check box A. They could not check the 98% offer method. Totally and completely fine. Nothing wrong with that. But check box D in line 22 if you can. So going through and filling this out, biggest thing that I want to point out here is what? Line 23, column A, check yes. If you're checking anything other than yes, call your school attorney, take a step back at least and think through this. If it is blank when you submit it, if it's no, they're going to assess you that enormous penalty if one of your employees goes to the insurance exchange, okay? So that still has to happen. If you forgot to check yes some year and didn't get a letter from the IRS, that just means none of your employees went to the exchange. Take a look at this. Make sure that you have that yes box checked. And if you are not checking yes in line 23, column A, contact your school lawyer, step back and think about it. So I filled out boxes B and C, or columns B and C over here too, just to give you kind of a gist of what it will look like. Your numbers may vary more than that, but typically, like we said, you're going to have more people in C than you are in B, because B is only full-time that month and C is all of your common law employees in that month. So not to belabor that point again. And then of course, there's nothing in D checked because most of you are not part of an aggregate group and you're not submitting in batches or anything like that. So the 1095-C forms. Let's start with the most difficult one and get easier. Classified staff members get an offer of insurance that requires them to pay 1/2 of their single. This staff member does not enroll in insurance. If they enrolled in insurance, what would we put in line 16? 2C, because we always put 2C if the person enrolls. So this is the only circumstance in which these two things are going to happen. Number one, you're going to have to use code 1E in line 14, because they are paying more than $102.63. So we can't use 1A. So because we're asking them to pay $300 plus in line 15, we have to use 1E in line 14. We have to put the amount in line 15. One of the things I want to point out is you'll notice in September, that increases from $300 to $321, right? So we can't use, even though it's 1E in all 12 months, we could have put 1E over here in all 12 months, but we can't use that all 12 months for line 15 because the amount changed. So in red is the big takeaway. All those safe harbor codes that we talked about, right, for the W-2, for the rate of pay, this type of circumstance is the only time you're really worried about those safe harbor codes. If you're using 1A, you probably don't need to worry about a safe harbor. So it's going to take a situation where you have 1E, where you've asked, so then now we have to fill out line 15 with the amount per month that they have to pay. If that does qualify this employee for one of the safe harbor codes, that's when it would go in there, right? So if you have 1A in all of your offers, if every one of your codes is 1A, you're probably never going to worry about those safe harbor codes, right? It's just going to be 2C because they enrolled or blank because they didn't in line 16. But this is the circumstance where we have to look at how much did we ask them to pay. We cannot use the W-2 safe harbor. Why? Because it's not the same each month of the calendar year, the amount we asked them to pay. So what we'd be looking at, since we know we couldn't use 1A, so the federal poverty line safe harbor won't work, what we're looking at is this person's rate of pay safe harbor. That's the only safe harbor that might apply here. So if it's a $50,000 a year custodian, there's a chance that when we take their $16 an hour times the 130 hours and then figure out where that computes out, 9.86% of that, if what we're asking them to pay is less than 9.86% of their rate times 130, we can put the rate of pay safe harbor, right? So that is probably the most complex that your reporting will get in these cases, short of if you are doing cash and lieu the wrong way. But this is the one where you'd have to think about, okay, we can't use 1A, we have to use 1E. We have to put the amounts in line 15. We have to figure out if any of the safe harbor codes might apply. This is because we required that person, if they enrolled in the cheapest single, to pay for half of it. Okay, a new teacher in August that enrolls. I think this one you're going to have fairly often. You'll notice that we could not use all 12 months for either of these boxes because the codes and the lines changed. January through August, they are 1H because we have not given them an offer of insurance that they have enrolled in. The difference between the line 16 though is January through July, they're 2A, but in August, they go to 2D because they're now in our wait period. They don't start till September 1st, but they are employed by us, right? They're in our wait period to get on EHA's insurance. So a new teacher that starts in August that will get on insurance for the first time in September would be coded this way. They're 1H all the way through August. They're 2A through July, then become 2D. And then when they enroll, right, they switch to 1A and 2C. 1A because we offered them the full family, 2C because they enrolled. If they didn't enroll, the only difference in this would be 2C in September through December would not be there. It would just be blank. And that is totally acceptable to have a blank in line 16, right, if they didn't enroll. But this is how you would code a new teacher that does enroll. Qualifying offer so you offer this teacher full family all year and they don't enroll. This is what it's going to look like. You're going to have one code in the entire form. That's 1A in all 12 months, blank, blank. This is the teacher whose spouse is also a teacher. They get the same 1A offer, but this is not the spouse that enrolled in the insurance. This is a teacher whose spouse has outside employment, who's 24, so still on their parents' insurance, right? They get a 1A offer from us, but if they don't enroll, it's blank all 12 months. So this will be a perfectly acceptable form, even though there's only one code in it. How about this one? A qualifying offer all year. So a teacher that has worked for us all the months of 2019, got a 1A offer but enrolls. The only difference, we add 2C into the all 12 month box because they got the qualifying offer, the 1A offer all 12 months, and they were enrolled all 12 months. Probably these two are going to be your two most common reporting, most common scenarios of all the reports that you'll make. Teacher resigns at the end of the contract year. I have a big red notation up here that says, when is a teacher effectively done working for you? Am I asking your insurance carrier? Am I asking NPERS? Am I asking the IRS? You see how that is different. So I don't want to create any confusion. And I especially don't want Orrin Hill or anybody else from the NPERS office calling me and saying, Bobby, what are you talking about? I get that the weirdness between this school says the teacher's ending date is, May 31st, so their effective date is June 1st. This school says no, their effective date is September 1st because we pay and benefits through August. I don't want to get into that. I want to tell you that I understand that issue exists. But how you code them, if you're Omaha and you prepay that pay and benefits so that they can get a June 1 retirement date, your form is going to look different because we are not employing that person beyond that time. But if you're a school that says teacher's actual retirement date is September 1st because we give them pay and benefits, then your form is going to look like this. So understanding the difference, let's assume that you're a school that says, because we pay you and give you benefits through August, your actual start date, right, your effective bona fide separation is September 1st. You would code it this way. They're 1A and 2C all the way through August. 1A because they got the qualifying offer, 2C because they enrolled. And then when they're no longer on your insurance, it switches in September to 1H, no offer, and 2A because they're not employed. That's it. We did it. 10 minutes left. Any questions? Send them in via text message. Shoot them in via the chat feature. I will stand here patiently and answer any questions or coding questions that you have. I don't see any coming in yet, but to thank you all for attending. I really appreciate it. I know this is a whirlwind course through this stuff. If you're brand new to this and you're like, I got maybe half of that, I totally get it. I do not envy you jumping into the middle of this. I've got some folks here that have been doing it for years, and I mean, there's just no substitute, I think, for having been in the trenches with this stuff for a while. So if you have any questions, obviously I'm happy to answer them. You can, call me at any time after this. If it's February 10th and you're like, I better start on these things and you have a question, give me a shout. What I will tell you is I generally, my wife works in fundraising for the University of Nebraska. So we are both working pretty steadily through the holiday season. And so if you've got questions, if you've decided you're going to tackle these things, in those weeks of Christmas and New Year's, let me know. I'm happy to answer them. At any point afterwards, I basically don't stop speaking Obamacare again until you guys submit these forms. So I would say through March 31st, I'll be pretty fluent in Obamacare if there's anything I can do to help. Other than that, if there are no questions, I don't see any coming in, we'll probably just hop. Oh, and there we go. We have one. Okay. Long-term para sub January through May. Roxanne, the question is, if you have a para that's doing a long-term sub January through May, what insurance did you offer? Because if you didn't offer insurance, that's still 1H, right, in line 14, which means you won't have a safe harbor in line 16. If you did offer insurance, the question is, what insurance offer did you make? Now, that's a value neutral question on my part. There are some schools that say, if it's going to be a period of 3 months or more that you're going to be full-time, we'll offer you insurance. But unlike teachers, where that may be spelled out, there's no hard and fast rule for when a para goes from getting an offer to not getting an offer. So the question is going to be, did you make an offer of insurance to this person? If not, it's going to be 1H, right, in January through May, because that person didn't get an offer. And then if they got an offer that they could have enrolled in, but then decided to stay part-time from August to September, that could change a little bit. But chances are, if they didn't get an offer the entire time or only got an offer in August, they're going to be 1H January through August probably, which means you wouldn't need a safe harbor code because they didn't get an offer of insurance. You probably also can't code that they're part-time if they really were full-time either. You see what I'm saying? If they were not part-time, it could be that line 16 is blank for you, which means if that person went to the health insurance exchange, you could potentially owe a penalty because they were full-time, they didn't get an offer of insurance. Any other questions? Shoot them in now. Okay, I don't see any coming in. Everybody just wants to get to lunch or to your now scheduled lobotomy, and I appreciate that. Okay, thanks again, everybody. Like I said, if you have any questions, finding the forms, getting the download, we'll try to get the video up there fairly soon. But if there's anything else that comes up, let me know, let Sherry know. We're happy to help. Thank you very much for attending, and I will end the webinar for all of us now.